once a month, different topic each month, but we bring in the best speakers around the United States to speak on different topics having to do with being a confident investor. So as the world is always changing, the economy is always changing, macroeconomics are always changing, we as good stewards of our own money get to continue to attend these type of events, continue to learn. So that, logistics, we are not selling anything on this event. Everything is being recorded. We will send it out to you tomorrow. And as far as what to expect during this event and after this event, okay, so we're going to run through a ton of information in the next 4 hours, 5 hours. We'll stay until we get through all the content. You guys will have had emailed to you a workbook. So if you've printed that out, have your workbook handy, have a pen and paper handy, your water, your coffee, whatever you need, because each speaker is going to come on for 30 minutes, but they are going to give you in those 30 minutes the best information that they share with their clients, with those folks in their coaching programs, with their traders, with their investors. So you're going to want to take notes on that. And like I said, second, we'll send out the recording. You can share it with whoever you want. You can review it as many times as you want. The more people that we are able to reach, the more, the happier we are. It's a better use of everyone's time, right? During this event, please be very interactive. We love seeing you in the chat. If you have a question, please put it in the Q&A section. And at the end of today, all the speakers are going to come back. We'll be on a panel and we will stay and answer all of your questions that we didn't get to during the event. What else on logistics? After this event, what does the follow-up look like? Next week, I am hosting an event and it is called Freedom in 3. And you can access it by going to www.freedomin3.com. And what we're going to do is we're going to dive deeper into what do you do with the information you learned today. And again, I don't sell anything during that 3-day masterclass. It's 3 days, 1 hour per day. And it's basically saying, what do we do next? So a lot of us attend these types of things, and then we need to take action. We need to implement it, choose some things that we learned and actually implement them to change our life, to change our financial situation and go forward. So that's what we're going to do next week. freedomin3.com, and you can sign up and we'll see you there next week. All right, with that, I see that the majority of folks are jumping in. Great to see you all here. Feel free to chat with everyone in the chat where there's the drop down, either hosts and panelists or everyone, select everyone. And with that, I'm going to share my screen and to the introduction. All right. Actually, one moment. Making sure I have the right thing up. There we go. Okay, share screen. I have so many screens up, you guys. So I'm like, wait, which one is it? Okay, here we go. All right, so who am I? Why am I doing this? I started my investing journey about 10 years ago when I had my first child because I realized, wow, I took a path into corporate that resulted in a lot of time spent at my employer. And I realized, wow, if I ever want to not spend all my time at my employer, I need to discover some other ways to make money. So I began my journey 10 years ago, and I'll get into that in a little bit more detail. But where I've ended up today is we have Sugo Capital, and it's an investment firm. We're an investment firm, and we specifically connect investors to passive income opportunities. So what is this? Today, we're talking about trading. Trading is pretty active. You spend your time going on the computer, making trades, setting things up. So I am a firm believer that it is great to be diversified in your portfolio. So some of your net worth may be in passive investments and some of your net worth may be in active investments. And so it's good to know what is the best fit for you. So that's what we're going to go through today. So Sugo Capital, we have acquired over the last, since 2019, 29 apartment complexes with our investor community. So not on our own, we pool investor money together to make these purchases together so that they are passive opportunities for our investors. That comes to about 880 million assets acquired. And I'm also on the advisory board of 2 other investment firms. So, going back to why am I doing this? What's the point of today? This moment was really, really important to me, and I'm going to go into it a little, but we're all here not just to make money, right? Money in our bank account doesn't do anything for us. The reason we want to earn more, keep more, is to change our life. So I want you to think about, what is your dream life? Why are you really here? Is it because you want to take more vacations? Is it because you want to retire earlier? For me, when I got into it, time freedom and location freedom were so important to me. So when you think about your goals, think about them beyond a number figure. Think about what is really important to you, your values, and then you're more likely to be able to set the financial goals to achieve the more intrinsic goals, right? So for me, values, time freedom, location freedom, very, very important. I didn't want to be in one location all the time at my desk for my whole life. Love traveling. So this moment is when I realized I had made it. I had done it. We were on vacation in France, in Arcachon, which is like oyster capital of the world. If you love oysters, the bay behind us has tons, like 25 different oyster farms. I'm a huge oyster fan. So we had been tasting oysters and seafood and wine for days on the French coast. And it was just such a wonderful trip. And my family was so happy, beach time for the kids. It was just beautiful, beautiful weather. And in this moment, we were taking this picture. It was the night before we were supposed to go home. And I said, oh man, I wish we could stay longer. And then my husband said, how much longer? And I realized it was possible. We could make those decisions in our life to say, okay, we're going to stay a week longer if we want on this vacation. We're going to go on more vacations, more frequent. We can be anywhere in the world while we're working. And that's one of the attractive things about trading, right? Is you can do it from anywhere. So a lot of the things we're going to talk about today are going to give you time freedom, location freedom, which is why they're so near and dear to my heart. And I hope that you can think about the goals that are really important to you and find something today that can help you reach those goals and achieve those goals in a time frame that you really want. Okay, so how did this come to be? I did not start out in investing. As I mentioned, I was working in corporate, so I thought the best way to have a financially successful life was to get straight A's, go to a great college. I went to UC San Diego. And then after I got out of college, I was like, I don't know, I'm kind of living paycheck to paycheck. The world is expensive, right? And so I said, I know the best way to be financially successful is to get more education, which it is. However, the education I got was I went and got an MBA from the UC system, great school, got another job in corporate, went from manager, senior manager, director. I was earning more income, but I was also almost living paycheck to paycheck still. And so I was living in Silicon Valley, working at a tech startup, and I was looking at people around me who were not going to work every day. And I said, what are you doing? And almost all of them said, we're investors with significant investments in real estate. So either they had made money in real estate or they had made money in their tech startup, going public or getting sold or whatever. They had made money in tech and rolled it into passive investments. And so I said, all right, I want to get on that train, right? So I started learning. So the key is to continue learning. I just shifted what kind of learning I was doing in order to shift my life. So I no longer decided to go get a PhD. Instead, I said, what coaching programs are out there that are very specific to earning income from investments and from real estate? So I went through a whole handful. The most impactful to my life were RE Mentor and the Rich Dad University. And I took every course that they had and I learned everything that I could. And not everything was something that I was successful at, but I kept trying, I kept learning and trying different things. And I ended up in apartment complexes, which is perfect for me, but maybe something else is perfect for you. So I kind of gave my accolades, but the thing that I am really most proud of is that we have served over 20,000 investors through education. And to me, that is the biggest honor, that I've taken what I've learned and turned it into what you're going to see next week in Freedom in 3, which is taking a look at all these different things you can do, distilling it down into an action plan for yourself. And we've had over 20,000 investors, high net worth investors go through our programs. And to me, like fast tracking anyone to reaching their goals, that is the best use of my time. So what are we going to do today? We're going to talk about how to do what the wealthy do, how to earn more, how to keep more, and how to grow more. So how to earn more in your investments, how to grow more with passive investments, and how to keep more with tax strategy. And we all want to invest like the wealthy. And I want to show this as I did not create this chart. However, it's really important. It's showing that on the left, that is a bar chart for individuals that have a net worth of less than $500,000. And how do they invest? The green boxes are traditional investments, and the orange boxes are alternative investments. Now, over on the right, that bar is the ultra rich, those with a net worth over 10 million. And you can see the orange bars, which are investments and alternative investments, is much larger than the green bars of traditional investments. And so it could be, yes, that they have more disposable income. They have a lot more net worth, so there's more to add to investments. It could also be that they have advisors, they have tax advisors, they have investment advisors who let them know, hey, you know, being in the traditional investments over at Wells Fargo with your investment advisor may not be the best thing for you. Alternative investments are really where the ultra rich make their money. And that's some of the stuff we're going to talk about today. Okay, so my results, like I said, it was not linear. It was not linear. I tried some investments. This is one of them where this is the before and after picture, and it's not what you want, right? You want the before to be the trashy one and the after to be your nice one, and you sell it for a profit. Well, I bought something that was turnkey, but I didn't do great due diligence on the property management company. This was my first duplex that I purchased. They put in tenants who had just been running from 2 other evictions. It was like, hello, obvious. I didn't think I had to ask, you know, don't choose someone who's running from an eviction, but I didn't ask that. And so the tenants destroyed the place. I lost it for a loss. I sold it for a loss, but I didn't stop. A lot of people stop right there and they go, oh, I made a loss in this trade, or I made a loss in this investment. I'm not going to try anymore. And I know you guys are not those people because you're here, you're learning, you're following the different speakers who we have speaking today. So I know you're the type of people who keep trying, keep learning so you can find out what works for you. I found that this does not work for me. So I squiggled around, not a linear path, but I ended up investing in hotel syndications and apartment syndications. I like these returns better. 18 to 25% annualized is what I was receiving. And it was all passive. I didn't have to be on the loan. I didn't have to be managing the tenants. If someone else is doing the work, and I was like, I love this. So then once I had my net worth in apartment buildings, in real estate, set to where I was really comfortable and I felt very secure, then I started adding on other types of alternative assets that in my mind were less risky. To other people, they were not as risky, but it's all, you know, everyone's different goals. So I found my base, I created a comfort zone for myself, and then I continued to explore and dive into different types of investments, like some of the things we're going to talk about today. So since then, this is a map of what we've acquired with our, this is my comfort. This is my comfort. These are all the apartment complexes that I own. I co-own them with our investors, but I feel comfortable that I have a base, right? And so then I can add on all these other types of strategies that we're going to be talking about today. Another thing I'd like to point out, and we're going to really dive into next week when we do the freedomin3.com event, is there is a moment, I told you I took about 10 years and I was learning and learning, but it wasn't until 2019, 2018 that I really started the path to 3x to 10x my net worth. That alarm clock is when I wrote down my goals very, very specifically. So what I want to encourage you to do right now on a piece of paper before we dive into all the content that people are going to be teaching today, I want you to write down on a piece of paper, why are you investing and what are your values? Please write it down. It's so important because we're going to see a lot of really, really cool things today. And if you try to go do them all tomorrow, it's going to be really difficult. But if you say, wow, I learned 6 different strategies and these 2 match my values, then it helps you say, okay, these are the 2 things I'm going to go try to implement in my life in the next 90 days. So really think about, are you investing for monthly cash flow? Are you like, I just need to quit this job. I need to quit my 9 to 5. So I need that monthly cash flow to replace my income. You're going to choose a different set of actions than someone else who's really looking to invest to reduce their taxes. And you're going to choose a really different investment than someone who's like, I'm good. I have cash flow. I have my W-2 job. I love it. I'm keeping it, or I'm running my business and that's going well. But I have all this cash and I want to build it for the future. Well, there are other types of investments that are really great for building your net worth long term. And so if that's your goal, then pay attention to those strategies that are great for wealth building today. So go ahead and write it down. And then if you have a goal, like a time frame of when you want these things, go ahead and write that down as well, because that's going to help you choose the action to take as well. Some investments, you can make money next month. Some, they're great for 10 years from now. So write down your time frame as well, and that'll help you choose what you see today, what will match your goals. So I do want to say a disclaimer, a lot of people, actually everyone who's going to be on the screen today, they're going to talk about a different style of investment. They are going to have numbers, projections, targets on the screen. I want to say, because my attorney likes me to say it, is there are risks associated with investing, all kinds of investing, whether it's passive or active, including principal loss. You can lose 100% of your money that you put in any of these strategies. Which is why you're here learning, so that you don't lose 100% of your money. So this is a snapshot of how I began my journey and choosing what was right for me. So I was going to events like this, and on the left, these are all different types of investments that I was looking at. And then I said, okay, what's the ROI? What's the cash flow? What's the level of effort? What's the risk? How much money do I need to get started? Is there a lockup period? Is there a tax benefit? And I was researching, and then based on my goals, I chose 4 things to go forward with. And that's what Sugo Capital offers. But I encourage you to do something similar for yourself after today, so that you can see what's aligned with my goals and what can I go forward with. And again, we're going to dive into this next week. If you want my support doing this, freedomin3.com. We're going to spend an hour Monday, Tuesday, and Wednesday next week diving into this kind of stuff. All right, now with that, one more slide actually, and then we'll have this first speaker come up. So how to determine what kind of investing is right for you. We did a slide, okay, or you want cash flow, you want wealth building. There's some other things to consider, right? Your vision, which I talked about my vision. Go ahead and write down, what is your vision? Why are you here? Why are you learning? And I know I already said that, but it's so important, because connecting to that emotional goal for you will help you take action after this event in order to get closer to those visions and goals. Really think about how active or passive you want to be. If you have all the time in the world and you want to be actively trading, actively investing, we have some great options the speakers are going to speak about. If you want to be passive, we're going to talk about those as well. What level of risk is palatable to you? Go ahead and write that down and make sure it's aligned with whoever you make your investment goals with before you make investments. So go ahead and write it down, like high risk is cool with me, or maybe you're like, well, I have 90% taken care of in this safe, comfortable stuff, and then 10% I want to put in some riskier stuff. I'm more open to seeing what I can do with that, something more exciting. And then again, set the goal. When do you want to hit your vision? When do you want to reach your values, incorporate those into your life? And then also, who do you need to tell? Do you need to tell your tax strategist? Do you need to tell someone you meet today? Do you need to reach out to one of the coaches and say, what you talked about, that is exactly aligned with my vision and my goals. How do I learn more? We're going to have 6 speakers, and they are all going to invite you to continue to learn more with them, since they only have half an hour today. All right, with that, I'm going to bring up our first speaker. All right, first speaker is Matt first. Come on up. Join the screen.
What's up, Sarah?
Hey, how's it going?
I'm trying to share my video, but
oh, well, let me allow you to.
like to say hi to everybody.
Yeah, there you go. Can you turn on your video?
Let's see that. What's up,
Beautiful.
everybody?
Great. Great to have you here, Matt. I saw
Pleasure,
that,
Sarah.
yeah, I saw you were on like 20 minutes early. I'm like, Matt's ready to go.
Oh, I was I think I was logged in at 7 a.m. my time, so I was excited.
Oh,
Yeah.
awesome. So everybody, Matt is with Tackle Trading. Tackle Trading they're not just this new pop-up. They've been around a while. They have been teaching traders how to make money in different kinds of trading. They're not just niched into one thing. They have a broad array. I mentioned in my slides, Rich Dad University, Rich Dad Poor Dad, that book. Matt began his experience and had a lot of his coaching and teaching experience in I don't want to say
Their
inclusion,
ecosystem.
side by side with that group. So Matt, I'm really happy to have
Yeah.
you here, and go ahead, take the stage, and let's rock.
Sarah, there's certainly commonality between you and I. You came through the Rich Dad, and that's kind of where I got my start as well with Rich Dad education back in the day. And eventually, I might have been responsible for some of your education since I was the director of Rich Dad Education and the architect of a lot of their educational systems on both the stock and the real estate side. And if there's one thing I know that Robert Kiyosaki and the Rich Dad organization preaches more than anything, it's cash flow. Cash flow, cash flow, cash flow. The name of the game is cash flow. To get out of the rat race, you have to get your passive cash flow to exceed your expenses. But as an investor and as a trader, let me go ahead and share my screen. Can everybody see my screen?
Looks good. Perfect.
All right. As a trader and an investor, everybody, what I have found is that, yes, cash flow is the name of the game, but there's every now and then there's an opportunity that is so great in my estimation that you don't want to cap your gains. And that's kind of what cash flowing in the market, specifically in the financial markets, does, is it caps your ability to have what is known as an open-ended risk graph, or the ability to grow, 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 grow. And that's what we call growth in the financial world. And I certainly understand that we all want to get a little bit more growth in our own personal lives as well. And so when I was, and first and foremost, Sarah, just a big shout out to you, just a massive shout out to you. Thank you so much for putting this together, bringing on amazing speakers from different asset classes to really kind of impact the financial intelligence of all of our communities. I just think it's an absolutely beautiful thing. And I'm just so proud to be a part of it, quite frankly. And thank you for the invite there as well. For those of you who that don't know me, shout out to Team Tackle, hashtag Team Tackle. For those of you who do not know me, my name is Matt Justice, and I am the CEO of TackleTrading.com. Sarah, you had your disclaimer. Here's my disclaimer for the lawyers there as well. Once again, my name is Matt Justice. I'm the CEO of Tackle Trading, and we put an emphasis on education in the financial asset classes. When I talked to Sarah about the topic I wanted to speak on here today, we're big in asset classes. We love trading in the financial world. We love investing in the financial world. We love all asset classes. We love commodities. I'm a big gold guy. But I just felt like artificial intelligence and what we're seeing in the market today is just something so new, so fascinating that quite frankly, I've been involved in the markets for 20 years. I've researched a tremendous amount of information out there, and I'm not sure I can paint a bigger or more compelling argument regarding the growth of the financial markets over the next 10 years than what AI can produce, because it literally touches everything out there. And so we're going to be talking about AI and artificial intelligence. And specifically what my goals here is, everybody, is I want to basically capture four things in the next 25 minutes or so. First and foremost, the number one thing I want to do is I want to have everybody understand what exactly is the AI marketplace. When we talk about AI in general, most people have a general understanding of what AI is. But when you talk about it from a market perspective, that's where it gets a little bit confusing. I want to define exactly what the AI market is. And then I want to get into what I feel is one of the most important things to understand when it comes to AI in the stock market specifically, is understanding the growth potential. there's two types of companies in the financial world, ladies and gentlemen, in general, right? You got value companies that we love to capture dividends on. We love to cash flow on those companies. We love to write covered calls on those companies. But then there's also growth companies that have the ability to substantially grow. And when you're talking about value companies, the arguments you make from an investor perspective is all about the fundamental analysis, PE ratios, PEG ratios, price to book ratios, free cash flow rates, those types of concepts from a fundamental perspective. But when you're looking at a growth argument, or excuse me, a growth investment, you got to make the growth argument. You have to have a data-based argument to back your position. And that's what I'm going to get into here today. And then we're going to start understanding the stocks that are leading this conversation from an AI perspective. And then we're going to focus on a little bit of the timing element of things. And that goes to the time and price regarding when to actually make the trade, how to understand and evaluate the price that you're paying if it is an appropriate price. Because at the end of the day, guys, you can have an understanding of the AI market or any market, quite frankly. You can make compelling growth arguments, compelling value arguments. You can build the end of all watch list. But if you don't have the understanding of time and price, you're going to be behind everybody else. And so time and price is your execution. In the first three, that's your preparation. But when it comes to executing the actual opportunity, you got to focus on time and price. Now, just a quick quote to kind of get us all in the right mood when it comes to the understanding the AI marketplace is from Jensen Huang, who is the CEO of NVIDIA. Now, for those of you who don't know who NVIDIA is, they are the leader in the horse race regarding all of this AI conversation. They started this AI conversation. They're the number one semiconductor company producing the chips that everything is built upon regarding the AI. And Jensen made a comment just a few months ago that was really quite powerful in my estimation. And he said, artificial intelligence is the most powerful technological force of our time. Its development and application will transform every industry, and its impact on our daily lives will be profound. I've been studying this AI marketplace for about 2 years now. And in my estimation, at no point in the history of my career, and most likely dating back to the 1980s, have we seen an environment where a new technology has the ability to impact legitimately everything in every space, in every industry, in every asset class, whether we're talking about real estate investing, commodity trading, or whether you're talking about the stock market itself. It doesn't matter because it has the ability to truly impact everything. And I really can't say, even with smartphones in 2006, or even with the websites that were developed in the 1990s with the advent of the information age, I'm not sure you can make an argument as compelling from a growth perspective as what we're seeing from an AI specific perspective. Now, a word on what is the AI marketplace. And what I want to do, guys, is I want to get the chat up here. So give me 1 second. All right, I got a question for you guys. First and foremost, give me a shout out to Team Tackle, hashtag Team Tackle. If you're a tackle trader, you know what that means. Second, scale this 1 to 10. 1, you know nothing about the AI marketplace. 10, you are the expert and you should be teaching this right now. How well does everybody understand the AI marketplace? Okay, so we're new. Sweet. There is nothing I like more than new, ladies and gentlemen. We love new. You want to know why we love new? Can anybody give me one reason why you think we love new? Like people like me, why do we love new? I love new. Love new. What's up, Rosemary? Easy. You got no bad habits. 0 bad habits. You are a fresh, you're a fresh board. No bad habits. I don't need to, I love that word, Paul. Don't need to unteach you anything, right? No bad habits. Fresh slate, clean, let's get up and go. And that is a beautiful thing, because when you deal with people with so-called quote unquote experience, oftentimes, ladies and gentlemen, it's not the experience that you're looking for, quite frankly. And so love that new. And so in the AI marketplace, ladies and gentlemen, it's made up of 6 components that make up the new technology that we call the AI marketplace. Now, the AI marketplace is the companies that are developing all of these technologies. And so these are the stocks, both public and private, and the big companies out there like Apple, Google, Microsoft, investing in private companies that make up the AI marketplace. And yes, we can invest in private equity. Yes, we can invest in public equity. We don't discriminate against either one of those. We love opportunity, period, end of sentence. Now, in understanding the AI marketplace and the companies that make up the AI marketplace, you first have to understand those 6 technological components that are building out this amazing new technological force. The first one that powers everything is what is called machine learning. Now, what machine learning is it's the algorithms that automatically improve through experience. And so ChatGPT, for example, you work with ChatGPT, and anybody that's ever worked with ChatGPT, the more you talk to it, the more you work with it, the better it becomes. It is self-fulfilling prophecy to a certain extent. Now, it doesn't learn from itself yet. It learns through humans doing the actual programming. A word on AGI, which is basically artificial general intelligence, when AI will start learning from itself without the human interaction. That's going to, whether or not that gets achieved by 2030, 2035, we don't know. But what we do know is that that will speed up the process in all of this adoption conversation that we're going to talk about here in just one second. So machine learning is the technological components that literally drive everything else. The forward-facing AI marketplace is generative AI. This is what a lot of people, a lot of companies utilize. There's software programs. Many companies in the financial market are creating these software programs to create generative AI, very popular on the consumer side, very popular on the content side as well. One I'm pretty excited for is the autonomous technologies that are being developed out of, for example, Tesla with their full self-driving technology. There's many car manufacturers out of China and the United States that are investing in autonomous technology. That one's really exciting. You have the computer vision market that kind of works hand in hand with the machine learning market, where they kind of interact with one another. And then you go into the AI robotics market, and yes, get excited. We're all going to have a personal robot. And yes, we'll probably have a sideline moment down the road a little bit, but before now and then, we're going to have a lot of fun with our personal robots. So get excited about that. But before we get personal robots, the robots I'm actually talking about are robots that are like developed from a healthcare perspective, that literally are AI produced, that help with heart surgery, for crying out loud. Really cool technology. And then how this all works together is honestly, it's not a new thing. I can promise you that. It's how humans interact with one another. And it's called natural language processing, or otherwise known as NLP, which allows computers to understand our human language. These technologies and the companies that are driving the innovation of these technologies are what we call the AI marketplace. And so right now, when you're looking at the AI marketplace, it's right now about $200 billion in revenue. And that seems like a lot, because it is. It was about $87 billion just a couple of years ago. So just in the last year and a half, we've over doubled from a revenue perspective regarding the actual revenue coming into these companies that are already producing all of these softwares, all of these technologies. And so right now, Joseph, you're seeing about 200 billion. And this is what's important here, guys, because once again, you have 2 types of companies in the market. You have really conservative, value-based cash flow companies. You take a company like Coca-Cola, for example. Nobody's going to make the argument that Coca-Cola has the ability to triple in price in the next 2 years. Like nobody's going to make that argument because it's not that type of company. It is a value-based company. They pay out dividends. They do stock buyback programs. They reward their investors. Growth companies, they do not reward their investors like that because their emphasis is on grow, baby, grow. And I want everybody to write that down. Grow, baby, grow. That is the intention and purpose and desire of these AI companies, is to once again grow, baby, grow. Now, when it comes to the projections of where AI is going, this is what I'm talking about from a growth perspective. You have to be able to make the growth argument, and this is my argument. And before I get into it, guys, just a couple words. There's only 2 situations that I can think back in the last 20 years that had the ability to do what AI is doing today. And if I go back in time a little bit, I would say number one, the first thing that comes to mind is Steve Jobs and the Apple iPhone and the creation of the smartphone in 06, 05. Nobody at the time knew what that was going to do. But all of a sudden, 15 years later, everybody and their dog has a smartphone and can't get off it. That had market penetration, 100% there, Joseph. Great innovator, Steve Jobs. But that had market penetration unlike we'd ever seen. And so it really did start something new. The second one that I would say that comes to mind is crypto, and specifically Bitcoin, when it was created in 2009. As a disruptive currency commodity to the fiat currency system. And I remember sitting down in 2013 and making an argument around Bitcoin, very similar to how I'm making an argument today around AI, in terms of understanding the growth potential of the crypto known as Bitcoin. And this is before anybody knew what Bitcoin was, ladies and gentlemen. It was a fad currency. It was on the edges of it was only people like me that really, focus on, anti-dollar analysis of where we want to put our currency. And Bitcoin had the ability to disrupt the currency systems. Bitcoin did not have the ability to penetrate the entire marketplace. And that's what AI has the ability to do. By the way, Apple's up like 4,000% since then. And Bitcoin's, I don't even know what the percent. It went from $180 to over $65,000 a coin today. And so in my estimation, and I can only tell you based on my data, and anybody that tackle trading knows, I put a tremendous amount of time into the research behind my theses. And the simple reality is I have never seen an opportunity in the financial world that has the ability to impact the growth metrics of the financial world like AI does. And it goes back to what Jensen, from the CEO of NVIDIA, said. It has the ability to penetrate every aspect of the marketplace, every aspect. Whether you're talking about a consumer staples company and you're talking about the efficiency argument that AI can do, or you're talking about a utility company, or you're talking about a communications company, or you're talking about, obviously, every other company in the marketplace, AI has the ability to impact their efficiency, if not their downright direct revenue streams. And this is what I call the $1 trillion horizon. Now, these numbers come from Wall Street research firms, ladies and gentlemen. These are not my numbers. This is my argument, but these numbers do not come from me. They come from 2 specific research teams called Market and Markets and PwC Research, which are Wall Street institutional research firms. And so this is where these projections come from. Now, one point for me before I go through the numbers. I think these numbers are a lie, personally, because these numbers do not take into account the indirect impact of AI, just the absolute direct impact of AI. And when you're looking at the growth projections of AI, the AI industry is expected to go from 150 billion in 23 to right around 210 billion in 2024. And by 2030, as we see mass adoption go through the marketplace, the AI marketplace is expected to put over $1.3 trillion of revenue every single year into the financial system. That, my friends, is a growth argument that is extremely, extremely compelling. The CEO of Microsoft said this just a little while ago. AI will serve as the backbone to the next generation economy, and I 100% believe that. Now, where these projections come from is they come from the expectation that AI is going to produce an annual growth rate at 36.8%. Now, ladies and gentlemen, how many of you would sign up for an annual growth rate of 36.8% in your retirement accounts? Anybody? Anybody? And once again, I think these are light, personally. Okay. Now, obviously, I saw somebody say, is there some negative aspects to AI? Yes, of course, there is negative aspects to AI. And if you guys want me to answer some of those questions, I will be here on the panel at the end of the program here today. I don't want to get too bogged down into questions, or I will be here for 45 extra minutes. And we got some wonderful, wonderful other speakers to get to. So I will be here for the panel at the end. But yes, I do believe AI will replace a lot of jobs. But here's the one thing that people do not talk about in that. What we don't know is what type of industries that AI will produce that nobody in the world knows of today that produces the next generation jobs. And so I don't get too caught up into the jobs that it's going to replace, because technological advancement has always replaced previous jobs, and it creates new industries. The projections are worldwide over the next 5 to 6 years that about 100 million jobs will be replaced in some aspect, one way or the other, and about 60% of that will be replaced with some degree of new AI software, new AI job, something along those lines. Now, when you're looking at what fuels this growth, guys, it's the user growth. Revenue doesn't come from nowhere. Revenue comes from companies and individuals spending their money on software applications and AI solutions. That's where this revenue comes from. That $210 billion in revenue, that's coming from people, organizations, users, you, me, companies like Microsoft investing and putting billions of dollars into the AI space. Now, that user growth right now is currently right around 314 million users around the world, okay? Around the world. I agree with that as well, but AI actually solves that fraudster, hacker issue, quite frankly. We'll talk about that on the panel as well. Guys, here's the thing. Do not let your fear of the unknown stop you from doing things you know you have to do. Does that make sense, everybody? Awesome. Exactly, BT. Exactly. Now, the user growth is expected to go from 314 million to over 730 million by the end of 2030. Now, in my estimation, once again, that is light. But if you were to think about this from a company perspective, guys, okay, if you were to think about this just from a specific company perspective, and their user growth went from 314 million to 730 million, what would their stock price do over the next 6 years? Where would it go? If the user growth literally doubled, revenue would quadruple, guys. The stock price would be up over 1,000%. That's what would occur if these numbers are accurate. The growth is absolutely fascinating. Jensen Huang of NVIDIA says the growth of AI users is the lifeblood of the AI revolution. Every interaction provides data, and every piece of data fuels the engine of AI innovation. I agree, AJ. I agree 100%. Stock price will be like it's on steroids. In fact, when you look at the last 2 years of economic data, when you look at the last 2 years of kind of what's going on in the economy, are we going through a great economy right now, guys? Like right this very second, is the U.S. economy ripping and roaring? Or are we dealing with some difficulties? We're dealing with some difficulties, aren't we? We're dealing with rates of inflation. The Fed has raised interest rates constantly over the last year and a half. We're going through a different environment. It's a difficult environment, and yet is the stock market at lows, or is the stock market at all-time highs? It's at all-time highs, guys. It's at all-time highs. Why is the stock market at all-time highs despite the economy not doing great? It's because of AI. This conversation is the number one reason the stock market is at all-time highs. The number one reason. There is not a close second. Without the advance of AI in the last year and a half, we are dealing with a completely different stock market. When you're looking at AI's growing contribution to the global GDP, right now, it's growing at about 1% of GDP. Okay. So right now, the AI marketplace is impacting the United States GDP by about 1%. If the projections that we have discussed are accurate, and I do believe they are, by 2030, the AI marketplace will be impacting not only the US GDP, but the global marketplace by over 10% of GDP, which would impact a total of $15.7 trillion to the global economy by 2030. Now, ladies and gentlemen, I'm not a greedy person. I'm an educator. I love teaching people how to trade, how to invest, how to take control of their financial future. I feel like I was born in this industry in the Robert Kiyosaki rich dad type mentality. And the simple reality is I do not need to be greedy to get my percent. But how many of you are just like me and you want your cut of the $15.7 trillion in new money that is coming into the market over the next 6 years in this AI development build out? Who here wants their cut of $15.7 trillion? We do not need to be greedy. And we're certainly going to give back. We're certainly going to give back. But we are absolutely going to do everything in our power to get our percent. And when you look at the two economies that are driving this, ladies and gentlemen, when you look at the two economies, it is the Chinese economy that is expected to have an impact of 26%, and the United States economy, which is expected to be impacted by 14%. That is massive, massive growth. And when you look at the future of AI, getting to these projections, right now, when you look at the US marketplace and you poll every CEO in the marketplace, 48% of companies currently are utilizing some degree of AI adoption. 64% of people polled suggest that AI is going to impact the efficiency of their companies. This number, ladies and gentlemen, will be 100% by 2030. 100% of every single company in the United States marketplace will be adopting an AI solution for their company. Period. End of sentence. There is nothing you can do about it. There is nothing I can do about it, because the simple reality is that if you do not adapt, you die in the marketplace. And companies that are late to this party when it comes to adopting AI solutions, they are simply going to be behind every single buddy else. And if you understand that, understand this adoption cycle that I talk about, ladies and gentlemen. This adoption cycle is the same adoption cycle that has been utilized throughout human history in how human beings adopt new technology. It doesn't matter if we're talking about going from the horse and buggy to the car engine. It doesn't matter if we're going from trains to airplanes. It doesn't matter if we're going from dollars to Bitcoin. It doesn't matter if we're going from old money to new money asset classes. It doesn't matter. This is the same evolutionary cycle of all new technology, ladies and gentlemen. At the very beginning of a new technology, 2.5% of the populace understands it and applies it. They are the innovators, the creators, the designers, the infrastructure behind it. They are the builders of everything. They are those companies that we talk about in the market today. Then you have what is known as early adopters that see the opportunity, that will do anything in their power to take advantage of the opportunity, and they come out there and take upon the risk for the growth side of the equation. Then you have it go down the road a little bit, and the early majority takes over. Then the late majority takes over. The laggards come into the market at the very beginning because they have to, and if they don't come in, then they die. How many of you know somebody that is still have like a Hotmail email address, for example. Some people just really never evolve. My question for you guys is this. Right now, where are we at in the AI adoption? Right this very second. Where are we at in AI adoption? We're very early, guys. Very early. This is a 10-year saga. This is a 10-year build out. It's going to impact absolutely everything. There's going to be industries that get developed because of this that we do not even know exist here today. What I would argue, based on everything that I know, is we are at the early adoption stage of the AI conversation. This is going to be a fascinating ride over the next 6 years. And we at Tackle Trading, we're going to be at the forefront of this conversation, the very forefront. And you can ask anybody at Tackle Trading, they will tell you that, because I feel it's our job to make sure our communities have an understanding completely of all opportunities that manifest themselves in the marketplace. Now, I got a little bit of a gift for you. My time is coming to a conclusion here. I could go on for another 6 hours, but I am as excited to listen to the other speakers as talk about AI. These companies here are the companies that are building out the AI marketplace. These are the companies that you want to put on your watch list to start tracking them for investment and trading purposes. These companies I will also give you guys a PDF here in just 1 second. So don't worry about writing everything down. You get the video, you can go back and you can, rewind and stop and do everything you need to do. But I'm also going to be giving you guys a PDF that basically goes through this entire conversation, lays out the growth argument, identifies the tier 1, tier 2, tier 3 companies. And so don't worry about that. We like to give you guys a lot of things. One quick point on time and price. Like I said at the very beginning, it doesn't matter if you have, let me put it like this. I've been asked the question many times, Matt, why are you so willing to give away the stocks on your watch list? And I do it all the time. I do all the time. The reality is this. It doesn't matter if anybody has the stocks that are on my watch list. It doesn't matter. What matters is if they have my knowledge over time and price. Because knowledge is the tiebreaker in the financial world. Everybody knows Apple, guys. Not everybody knows when to buy Apple. Everybody knows Tesla. Not everybody knows when to buy Tesla. Everybody knows Microsoft, NVIDIA, and Google. Not everybody knows when to buy them. I do like ANET. That is true. I do like ANET. But there's a lot of semiconductors out there, Arthur, that are, building out this. I would put them a little further behind the AMDs, the ARMs, and the NVIDIAs of the world, personally, but I do like them. When you're looking at time and price, this is the separator of all of them. ARM Holding is a semiconductor company, AJ, that is coming out with a new AI chip next year. When you're looking at time and price allows you to answer the ultimate questions of when to buy, quite frankly, when to sell, and whether or not you're paying a proper price. That's what knowledge does. It allows you to execute with confidence anything on your watch list. It allows you to buy when you should, sell when you should. And yes, there will be many, many, many AI companies out of India and China. Now, the timing element of this is based on technical analysis, ladies and gentlemen. When you look at the study of technical analysis, it's the study of trends, patterns, and support and resistance. That allows you to understand your timing element. If I'm ready to buy, it's because the market is telling me I'm ready to buy. When you're looking at, for example, NVIDIA, we had NVIDIA on one of our watch lists for a trade, not when it was just hanging out, doing absolutely anything. Right here, that's Microsoft. Let's go to NVIDIA here. I'll just give you a recent example. So do you see how NVIDIA right here is doing absolutely nothing, just kind of sideways, 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 sideways. But do you see right here at 500 how it starts to consolidate here? Well, ladies and gentlemen, we nailed this trade at Tackle Trading. It broke out and then it ran. That's the timing element that I talk about when it comes to the execution of any of these concepts. And so it's important to have an understanding of the space, of the argument for the growth, of the stocks that are impacting the conversation. But at the end of the day, you have to understand technical analysis and then fundamental analysis, which helps us understand the valuation component of PE ratios, forward PE ratios, PEG ratios, and price to free cash flow ratios. And ladies and gentlemen, that's truly what we do at Tackle Trading is we teach people to identify the technical aspects of things with an understanding in the backdrop of the fundamental conditions. And that is what we can help you do. The last thing I'll say is the first thing I said regarding Jensen and AI. And I want to see if you guys agree with me on this now that we're coming to a conclusion of my part of the presentation. AI is the most powerful technological force of our time. Its development and application will transform every industry and impact our daily lives will be profound. How many of you guys agree that AI is something that you absolutely have to understand, that you absolutely have to be at the forefront of? And ladies and gentlemen, with that said, that it comes to a conclusion of my part of this presentation. I hope you guys truly enjoyed the AI conversation. A good friend of mine, Guy Cohen, is coming up here in just a second. So let's give a big welcome to him as well. I'm going to be putting in a link for the AI stocks very quickly. If you guys want to get a free PDF of all of the AI stocks on that list, you can go over to that website right there. And with that said, Sarah, I'll give it back to you.
Thank you so much, Matt. And yes, the links are in the chat. And when we send out the recording tomorrow, we're going to have a speaker bio page, and it's going to have all the links to all the freebies and all the speakers, so you can get in touch with them. Grab it now, but know that we'll also send it out again to you guys.
Thanks, everybody.
All right. Thank you, Matt. That was awesome. All right, next up we have Guy. Let me enable your video, Guy. Come on up. Let's see. All right, are you here, Guy?
I'm here. Can you hear me?
Yes, I can. Are you able
Little
to
tap there, and I'm going to put the video on. Okay, there you go. That
There
looks
we go.
like I'm.
Oh yes, look at
looks
that
like I'm
background. Look
here.
at all those charts moving. Beautiful.
This is
So,
my den,
your den. Awesome.
the lair.
Beautiful. So Guy's
Okay.
here. He's from Wise Traders. You're in England, but a lot of the folks that you work with are in the US. Is that correct, Guy?
Oh, I'm a US guy. Consider us the 51st state. You just don't know it yet.
So Guy, I know we're a little bit behind, so I don't want to spend a lot of time. I want to just like hand it off to you and let you run. I know you've got some really great information to share. So thank you for being here, and take it away, Guy.
Thank you. I'm actually just going to share my screen. Let me just make sure that's working for you all now. Just give me a little wave just to make sure that
Beautiful.
I can see that. And Sarah, thank you so much for having me on this. I truly appreciate it. And also want to say a shout out to our mutual friend, Matt, who introduced us in the first place. So I just want to say a big thank you. And I hope that you're going to find what I'm about to do to you guys entertaining, hard work in terms of I'm going to get you scribbling. So if you have got your pens and papers or whatever you do, or tablets, get them out right now, because we're going to go through quite a lot in a short space of time. So this particular piece is all about what we do is called following the big money. And I'll introduce you to myself and to everything else that I do in just a moment. But before I do begin, this is just something I slid in there while Matt was speaking. Do we use AI? And the answer is hell yeah, we do. So we're just one of the many people who use it. We use it in a very specific way, a very selective way. But I will also go into all that as we go along. So who am I? Well, if you don't know who I am by now, I'm Guy Cohen, the founder of Wise Traders. I've also just become a portfolio manager of a hedge fund. And Wise Traders, which is why you're here, is all about empowering private investors with a particular way of trading the US markets. I say US markets because we specialize in US stocks and options. I've been around for quite a long time. I've got a couple of best-selling books in there that some of you may have already have read already. Most people seem to have read them somehow. So that's one thing. And also I hold the creator and the holder of a US patented indicator, which we're going to go through today. Does that use AI? Oh, yes, it does. So we've been using AI in its various forms for quite some time as well. And I've also had blue chip clients, institutional clients, such as New York Stock Exchange, Euronext, International Securities Exchange, now owned by NASDAQ, various brokers, and of course, now, as I mentioned, I'm now a portfolio manager at a hedge fund as well. So I've got some unique things to share with you, and we're going to have a lot of fun while we're at it as well. So the first question is this: what makes you feel more confident? By the way, I'm doing something I have not done before today, so bear with me on this one. What makes you feel more confident when you're making an investment? Let's go through some factors that might, and attributes that might help you or might help you feel more confident. So the first one could be that you see that other people are buying. So give me a wave or put something in the chat if that would make you feel more comfortable, more confident, knowing that other people are visibly buying it. One person says no, there's always going to be one. I'll come to it in a minute. You're not the first in, you're not the last in. So if I can caveat that, but you can see that other people are already buying in. The second attribute is that the price has already started to rise. It's not at its bottom, it's nowhere near its top, but it's starting to rise. So there is this affirmation, if you like. Okay, pretty good. The third attribute, what if this thing is starting to get more attention? Maybe it's one of the AI stocks. If you think about what Matt was just saying, AI is getting more attention. AI is not at the start of its journey, but it's nearer the start than its conclusion. So AI, if you want to talk what Matt was talking about, fits the bill so far. Okay, well, we'll come on to that in a minute, Addy. I'm seeing the comments coming in here. Great stuff, by the way. Okay, so it's getting more attention. And I'm going to show you why these might be really important as you move forward. Next, what if you were to be able to tell that professionals are leveraging up on it? Would that make you feel more confident when you're making this investment in a particular stock? When you see that professionals are potentially leveraging up on it? How about this one? How about if you could see, which not many other people could see, that sellers are getting overrun by buyers? Buyers are taking over. Demand is outweighing supply. And finally, keep those thumbs up going, or whatever you want to say. Finally, what if you could, with this particular stock or investment, enter with complete control? You're on your terms. You're not chasing, you're not being given a stock tip. You're entering on your terms where you can control your risk and anything else you need to. So this is what I'm going to be demonstrating as we go along today in this session, are what we call big money footprints, because that's exactly what we do. We follow the signs that big money is there and more big money is coming. So this is a recent chart of GameStop. Now, I have to say, this is absolutely not my kind of stock. But what you're seeing on this chart here, you'll recognize later on, because what you're seeing on this chart is big money lining up before this happened, before it went up by threefold in just a couple of days. But the signs were there. Again, I hasten to add, by the way, I'm not the kind of guy who goes and buys GameStop, but that was what happened before. What about this one? This is also big money lining up, but I'll tell you where it's lining up, and you'll recognize this very soon. This is big money lining up the other way. In other words, bearish, because this is what then happened to this stock, Globe Life. We saw that literally at the end of March. And then what happened? That happened all the way down by what, 60% in 2 weeks. we saw that. It's on my watch lists. This is what we do. We follow the signs of big money, and I'm going to go through each of these 6 big money footprints as we go along today. First of all, though, why do I focus on stocks in the US? Well, first of all, let's have a look at the other asset classes. First, there's real estate. Love real estate. I actually started my career in real estate, so there's nothing wrong with that. Do you want all of your eggs in real estate? Well, possibly not, because, you know, it's a somewhat illiquid asset, and it's subject to, you know, local policy, sometimes national policy. So, and obviously a lot of people have a lot of debt tied in with real estate as well. So it's a great asset class. I'm all for it. But do you want everything in real estate? Probably not 100% of your portfolio. What about bonds and commodities? Well, great, again, if you know what you're doing. And the key to these asset classes is if you know what you're doing. They are kind of specialized. You know, when you talk about investment banks, they have whole teams only dedicated to bonds, only dedicated to commodities. In fact, only dedicated to a certain type of commodity as well. So you really need to specialize to know those ones. What about crypto? What about FX? Well, they're not my bag, as you know by now, but they do have a part to play in certain investors' portfolios if you want to go that way. Now, all I would say is that crypto is still a very young asset class, and it is somewhat speculative. There's not much analysis you can give to it. And again, if you look at most of the crypto assets, they tend to be not the kind of quality you want, but there are some that are going to take over, a bit like the internet stocks from, you know, 25 years ago. There was only a few when the consolidation happened that took over. When it comes to Forex, I'm not a Forex guy. There's one issue with Forex that I have, and that is very difficult for any retail investor to have a palpable edge, a palpable information advantage. So I don't tend to go with that one either. And then you've got alternatives such as, you know, fine wines, art, you've got classic cars, all that kind of thing. And again, somewhat illiquid, although typically with tax benefits, and somewhat specialized as well. Now, they're all fine in their own right for the type, you know, there may be different people in here who gravitate to one or several of those. What do I do, though? Well, I do stocks and stock options. And the reason I do it is because stocks are truly the only asset class where you can confer an empirical, that means a proven quantitative edge for private investors. And we are all in this class, at least, private investors. So going back to big money, moving a stock, here was big money. And this is, by the way, this is me in the corner here saying, I think this looks pretty good at the time or before the jump happened. And that went up 30% in 12 days, with big money being evident before the move. There's CRISPR, 35% in 5 days, big money being evident before the move. By the way, are all the stocks highlighted going to do this? Of course not. Just like Sarah said at the beginning, you know, you can lose money as well as make money in stocks and any asset class that you're choosing to invest in. But I just want to show you some interesting examples of stocks that we saw before they did go up. Sear, Cerebral Therapeutics, 61% in 4 days, with big money showing up before, as I will show you. Cytokinetics, same kind of deal, 112% in 6 days. Imgen, 80% in 3 days. Again, big money. You're going to recognize when you see these very shortly, you're going to recognize the kind of setups that were forming in a minute. KRTX, same kind of deal, same kind of setup. Interesting result, 60% in 18 days. And then there was Mertex, 40% in 6 days. Now, those of you who are good at recognizing setups and patterns might already start to be seeing a common thread here, but I'm going to show you those in just a moment or two. Now, the investment or trading criteria and what we stand for, you could summarize by calling it the 3 master keys of trading. And they are market timing, which makes sense. If you're on the right side of market timing, then the tide isn't going against you. So that's the first thing. Market timing is known to be something of a holy grail in trading. But if you're good at market timing, an awful lot of hard work is already done for you. At least don't fight the tide. The second master key is stock selection. This is where we talk about the big money footprints. And the third master key is your trade plan. This is about your risk management. All these three master keys are essential. Today, we're going to focus on stock selection. That's all we have time for. So let's have a look at it. And for stock selection, we talk about those lovely big money footprints. So let's go through each one of them. Big money footprint number one is the presence of big money. Remember, we talked about it earlier. There's other people visibly buying something. You can see it already. How does that manifest itself in a chart? By recent volume acceleration. So on the left-hand side, you see these big volume bars. That's the number of shares that have been traded. Big green volume bars towering over the previous bars that have gone before them. That's how you can spot it, potentially with a stock on the way up. And on the right-hand side with the red bars with stock price going down, potentially with people getting rid and distributing the shares, where shares might go down, share price might go down. So recent volume acceleration can be a sign of big money accumulating. And that's the key bit to this, is what are we looking for here is potential signs of accumulation. That means people buying and hoarding, at least on the way up. Big money footprint number two is all about aggression. Now, we talked about this earlier. We talked about a price that's already started to rise. We're not bottom fishing here. How does that manifest itself in a price chart? Well, recent price acceleration. Often this will happen right after an announcement, like earnings. And ideally, what happens is the price will jump and then go sideways, giving us an opportunity moving forward. And what's this all about? Well, again, it's all about eyeballs looking, and the more eyeballs that are looking, the more possibility there is for an inflection point. Again, another sign of potential accumulation. Now, why is that important? Because if people are hoarding, there's less supply. So third big money footprint is key levels. What's this all about? Well, remember what we said earlier. What if this thing, we talked about AI stocks, but it's getting more attention. More people are looking at it. Well, that's interesting too. And people tend to be looking at things in the stock market when they cross and are near key levels. It's no science to it. The 200-day moving average was made famous by Paul Tudor Jones. He said he only buys if a stock is above its 200-day moving average. Well, guess what? Everyone's now got alarms and alerts on their 200-day moving averages on their stocks. So people are watching, hence those lovely little eyeballs they're looking. The more eyeballs are looking at a particular level, the more chances there for an inflection point in terms of price behavior. So key levels is important. More attention at certain places. So it pays to be, on that. Again, it's another sign of potential accumulation, another sign of potential supply being constrained, and therefore more demand or even same demand can force a price up in that case. The fourth big money footprint, we talked about, well, what if professionals are leveraging up on a particular stock? Wouldn't that be good to know, especially if not many other people know about that? We call this scarce information. I'm going to go into it in just a minute. But for now, let me go through the concept of why prices actually move. So I'm going to give you a little example here. Why do prices move? Picture your dream home. Here it is, asking price $950,000. That's pretty cheap for that. And I'm going to give you three scenarios that also apply to trading as well. The first scenario is that everyone's bidding the same. Everyone's got the same information. Everyone's bidding the same. And they're bidding the ask price. So guess what? You bid $950,000. Bob, $950,000. Sue, Jim, everyone's bidding $950,000. The asking price is $950,000. What's happened? Nothing. So big money on its own isn't quite enough to move the price. So now we go to scenario number two. And scenario number two is all about public information. Imagine the scenario where 5 miles down the road, Google have announced that they're going to be opening up their new headquarters. 5,000 people are going to work there, and it's going to be a whole big thing for the neighborhood. Now, what is going to happen to the neighborhood? Well, Bob surmises that there's going to be new facilities, new roads, improved schools, new restaurants, leisure facilities, gyms, the whole works, cinemas, movie theaters, the whole thing. And so he's prepared to now increase his bid to $960,000. Sue, $970,000. You say, actually, I think this is really going to go up. I'm going to bid $990,000. Jim puts his bid up to $1 million. You now bid $1.1 million. You see what's going on. Everyone's got the same information, but now there's a bidding war. Now there's big money, but there's also aggression as well. And that's what's forcing the price. People are climbing over themselves to get this house. So it's big and aggressive money that's moving the price. But there's a third scenario, and this is not public information, but it's scarce information. Now, here's Bob, and he's a very thorough guy. He does his due diligence, and he's gone around, walking around the neighborhood, and he's found that behind this property is a big parcel of land owned by an old couple. He's gone and knocked on their door, and he's discovered from them that privately, with no one else knowing, they would be prepared to sell him that parcel of land, thereby increasing the potential profit and value he could have by buying that and the house itself, which means he has scarce information, which means he is now prepared to bid more for this house, knowing the value he can add. So he can now bid more than everyone else. He's going to bid $1.2 million. And this is the big point. Information's important, but scarce information, well, that's potentially on a whole different level, potentially life-changing as well. So going back, big money footprint number 4 is all about scarce information, all about maybe professionals leveraging up on a particular stock. What's that a little bit like? Well, it's a little bit like this, isn't it? It's a little bit like, think of a diamond dealer. Diamond dealers have scarce information. What happens with a diamond dealer? They went to diamond school. They know about the cut, the clarity, the color, the source. They know more about a diamond's price than you do when you're buying it. Therefore, their markup is high, 100 to 200%. Think of Coca-Cola. What's their scarce information? Their scarce information is their secret recipe in that vault in Atlanta. KFC, their scarce information is what? Well, that's their secret greasy recipe for fried chicken. And what do all these things point to? Well, scarce information leads to a repeatable plan and potentially repeatable profits at scale as well. And that is what you need to be looking for when you're looking to trade. You want a repeatable, proven strategy, hopefully with scarce information at its core. Now, with what we do, we use what's called the options volatility indicator, or OVI for short, which is a simple line that measures what options traders are doing. Now, as I said earlier, do we use AI to calculate this very simple line? Yes, we do. When it's red, it typically means that there is more bearish activity in the options world. And when it's blue, it typically means that sentiment has shifted bullishly. And it's reflecting trading activity that is more likely to reflect professional activity and sentiment, but crucially, position building activity, accumulation activity, more than just unusual options activity that everyone else seems to be obsessed with right now. It's different. And because it's different, it's scarce information. And because only a few hundred people have a hold of this information, it's scarce information. And because it has a US patent in my name, it again is scarce information that we can use. I'm just trying to find my mouse here. Okay. So what's this one all about? Well, again, it's all about potential accumulation and knock-on effect on the stock price. So why is the OVI also important? Because there is deep empirical evidence for it. There are portfolios running with professional money managers using various aspects of OVI right now. And this is the difference between OVI in blue and the S&P, its benchmark, in red. Significant difference over the short, medium, and long term. There is empirical evidence. Does it guarantee a profit? Of course it doesn't. On every trade? Of course it doesn't. But over the long term and over an awful lot of not just research and testing, but in the field as well with live trading. OVI portfolios are being used by professional money managers to manage client accounts, and it has an empirical advantage. So now we go to big money footprint number 5, and we call this, we talked about before, sellers are being overpowered by buyers. Well, is there a physical manifestation that we could lock into to see that? We call it shrinking retracements. So if you look at this chart of Sarepta, you see this line here, which is quite a deep sell-off from 90 down to 65. It's about a 40% sell-off, followed by a much smaller sell-off, followed by pretty much a consolidation, a much smaller sell-off. Now, could you find these? Yes, you could. Could you eyeball them? Absolutely. But you can see here very clearly that one side is getting overrun by another. Sellers are being overrun by buyers. What you might also notice is that at that point here as well, guess what you've got? You've got the OVI turning blue as well. That's turning bullish. Now, some people might talk about this as a famous kind of head and shoulders or reverse head and shoulders setup. It's not really head and shoulders, it's shrinking retracements. That second sell-off is far lesser in extent percentage-wise than the first sell-off. Sellers are starting to get run out of town. And again, it's another sign of potential, on the bullish side, accumulation. The 6th big money footprint is what we call consolidations. Now, we talked about entering with control. How do we enter with control? With a trade plan. And a great plan to have is if you have a sideways move in a stock. Stock goes up, goes sideways. Now you have the parameters to buy and to get stopped out, and even to set profit targets as well. So consolidations can be very useful for control. They can, in certain circumstances, also be classed as a big money footprint in their own right, particularly if volume is also shrinking at the same time. It means that after this move up, this sideways movement means there's not really much selling action going on. So buyers have well and truly taken control in context of the other big money footprints as well. So it's another potential sign of accumulation. And that's what we're all after. These are the 6 big money footprints, all in evidence with this particular stock right now. Look at this. There's big money footprint number 1, the volume acceleration. Big money footprint number 2, the price acceleration. Big money footprint number 3, the crossing and holding of the key levels like the 50 or the 200-day moving average. Big money footprint number 4, OVI, the scarce information, secret thing that no one else knows about. Big money footprint number 5, shrinking retracements, sellers being run out of town. Big money footprint number 6, consolidations of price and volume. That's it. And that led to a 49% increase in price for Sarepta in just 7 weeks after it was spotted. So when you look at it, when you look at what we talked about earlier, what would make you feel more confident and comfortable about making an investment, they're actually the big money footprints as described and as exemplified in the chart, but they're really an anthropomorphization of real behavior, real buyer versus seller dynamics. There's the big money footprints. And of course, the OVI and shrinking retracements are unique to what we do. So I'm now going to go into my platform just to show you a little bit of this because it's kind of cool. I'm going to show you all kind of fun things in it just for a couple of minutes. We're not going to take too long in this one. Let me just find where it is. So here we have a beautiful platform with lots of nice bright colors, and we have charts. So this is our chart, and in that chart you see OVI. In this chart, particular one, you see Goldman Sachs, you see OVI blue. Beforehand, you will have seen lots of big money footprints in this area here. When it started to go up, you will see, if I actually extend the chart, other big money footprints which were happening right about here and here, as you can see. And of course, the result has been a nice rise in Goldman Sachs and other financial stocks as well. So we have beautiful areas which have what we call pattern recognition. So you can actually see patterns forming and they just pop up beautifully, brightly in your face as well, with big money footprints showing up and others as well. We have this lovely watch list area that you can control, and also this great little list of big money stocks watch list. A few AI stocks are in there as well, but you can have any watch list you choose to curate yourself. Obviously, I showed you the OVI. I'm going to show you something else in a minute. Little thing here called the profile, that also has the pattern recognition in here. Isn't it nice and pretty and easy to interpret as well? We also have this thing called the journal. Here is a lovely journal. You can actually keep a journal. So if you look at this one, this was November 29, 2023. Where's that? Right here, right before. That's a journal entry that I made. So you have a journal. All you have to do is click on the journal, add a plan or add a note. Beautiful. You can do anything you like with that as well. So that can take you literally 30 seconds to put a trade plan in or a little note as well. We also have a lovely other little thing that we have. You can actually view all your journal notes, by the way, just by clicking on there, and you can see all your other little journal notes you've made. You can keep a little diary in this beautiful application as well. And also we have this other thing. There's so many things, but this other thing called the gift area. Well, the gift area is where I might say, hey, watch a video on how to do this, or have get a cheat sheet on your key habits, and you can then download a cheat sheet. Download, something about your optimal routine or the optimal trade plan. So you have a little gift area in here as well, which is pretty cool, that you can download anything that's in there whenever you want to have a look at that as well. It's a very lovely user-friendly platform which focuses on one thing and one thing alone, and that is the big money footprints as well. I'll just go through those again. So there's the charting area, which you saw, nice and simple, not over cluttered. Here's the watch list area, which can expand and you can control and do whatever you like with it. Here's the pattern recognition areas. Again, super easy. Green for bullish, red for bearish. Here's the OVI, the thing that no one else in the world has, secured by my patent, used in hedge funds. There's the journaling area, really easy to do, and also gifts as well. And there's 100 other things as well that you can do as well. You can even determine what kind of trader you are by answering a few easy questions, and it'll tell you what kind of trading you're most suited to. Now, the way to get this is go to ovi.to/platform. Hopefully someone will put that in the chat. If not, I will do it. In fact, I will do it here. If I do, oh, there you go. Oh, Cynthia. Cynthia is way ahead of the game. So ovi.to. Now, if you wanted to find these big money trades, well, there are two ways you can go about it. There is a way you can do it manually, where you can filter for volume behavior, you can filter for price behavior, you can filter for key levels if you knew how to. You could filter for, well, you couldn't filter for scarce information because only we have that. That's the OVI. Could you filter for buyers versus selling action, the shrinking retracements? That doesn't exist elsewhere. Could you filter for consolidations? Yeah, you probably could do. And you could also filter for, well, you could also then create your trade plan. Now, all that would take quite a long time. There is a better way where you look for big money footprints and you look for them quickly using a quick and easy plan, and then you can repeat that for scale. That plan is all important. Remember those master keys at the beginning, and that's more like a fast track if you wanted to do that later on down the track. Again, this is the system. The three master keys of trading is the wise trader system, which is market timing, stock selection with the big money footprints, and then your trade plan. And we don't have time to go into market timing or trade plan, but you can imagine already and appreciate how important they are to control, for you to be in control. Now, just a little bit about us. We are a team of human beings. We don't do everything with AI. Our support is real human beings. Of course, we use a little bit of AI to help us along. Of course we do that. But we're real people in tech, real people in the quant team, real people in support, real people in mentoring, real people in our communications. And I, if you haven't figured out by now, I'm also a real person, which I think people like, even with AI going along there. So you can now join this platform for free, have a play around. If you want to escalate later on down the track, you can do that too. But the link is ovi.to/platform, and enjoy it with us. Join us. Get in the family. We're pretty much like a family, and I think you'll find it liberating, exciting, and very, very cool. I know there are some other big fans in the industry of ours as well. I won't go into that right now, but you'll find us very approachable, and I think I've pretty much done about half an hour there. So again, ovi.to/platform. If there's anyone else who wants me to do anything, say anything, get in contact with us on the platform. There's support in the platform there. You got a little question there. You can even do that. Let me just see if I can do it before Sarah's going to kick me off here.
I'm just available as you.
Don't worry, I'm not. You kick me off when you want. But just so you know, in here, just a couple of other little fun things. You got videos. Now, these video we develop very quickly. You got little help videos in there, which are kind of cool. In the platform, you got this. That's our little chat help, which has a little bit of AI in there. There'll be more as we go along as well. And there's this other very cool little thing, which I didn't show you, but I could do. It's called this thing here. It's called the little questionnaire, and it'll then tell you what kind of trader you are, what you are more suited to. Just literally about 7 questions, take you about 45 seconds. It'll tell you what kind of person, well, not what kind of person you are, but what kind of trader you are, what you're most suited to doing. Anyway, that's pretty much it from me, Sarah. I hope that enables you to catch up a little bit or not lag behind even more. I'd love to talk to everyone, but I know you've got things to do, and love to catch up with you after all this as well. I hope that's been helpful to everybody.
That was really cool. That last thing is really cool because people are always, you learn so much and then what's right for you to take action on. I'm a huge fan of figuring that out. So that's nice that you have a little tool. 7 questions, 45 seconds. That's really cool. I suggest everyone jump in and do that. And it helps narrow down your choices because you're going to learn a lot today.
Yeah. Oh, yeah. You're going to have, I'm glad I came at the beginning because you're going to be way overloaded soon.
Yeah. We still have a lot more to go. Well, that was awesome. Thank you so much, Guy. This is beautiful.
Thank
The
you.
links are all in the chat, you guys, and we'll send out all of Guy's links tomorrow when we send out the recording. So I appreciate it. Guy, did you say you're going to come back for the Q&A at the end?
I will. Of course I will.
Oh, you will. Okay.
And it's a different, is it the same link or is it a different link? We're just
Same
joined
link.
back in here.
Same link. Mhm.
Okay, I will keep this open. I'll be listening and
Okay.
watching quietly
All
to
right.
myself.
Perfect. Well, thank
Thank
you.
you, sir.
Yes. All right. So up
Thank you.
next, we have Dana. Dana, let me add you so you can turn on your video. And welcome, Dana. How are you?
I'm good, Sarah. It's great to be here with you and with all of your viewers today. So thanks for having me.
Oh, definitely. Good to see you again. So Dana's going to talk about gold. Obviously, you can see behind him, American Gold Exchange. So you've been investing in gold for 20 years. Is that?
Oh, I've been in the business for 44 years. Got a little snow on top of the mountain here. I've had my own business for 25 years now, American Gold Exchange.
Okay, that's where I was remembering the 20 from the business. Yeah, it's awesome. So, a lot of stuff that we've been talking about today is a mixture of traditional plus something cutting edge. And I think that's really interesting and very time appropriate because there are trading and investing principles that are timeless. And as confident investors, as astute polished investors, we get to keep learning, but how do we adjust the traditional to continue to have it work today for me? So I'm really, gold is one of those things that people are like, oh, do you trade it? Do you buy and hold it? Or is it still a good thing? Is it still worth it? Because Bitcoin's coming out, all those kind of things. So I'm really happy that you're here to speak with us about it.
Well, thank you so much for having me again. I'm an old timer. I've been around a long time. So I've got a history lesson for you today. I've got some market information for you, what's driving the market, where I think it might be going, and how you can harness that if you want to, enter into the physical precious metals arena, which is my expertise.
Awesome. We do a lot with gold as well. So I'm excited to hear what you have to say. Take it away, Dana.
All right, I'd like to share my screen if I can do this correctly. Give me just a second. Oops. Let me see. I've got 2 screens here and I always start to get it wrong. Let's see. Share this one.
That's the blank. There we go. Perfect.
All right, so here's my company information. Here's my contact information. I've got a pretty dense presentation. I'm going to go a little bit fast, but there will be a replay. So let's get started. Gold has been around for almost 5,000 years in man's history. And these are the reasons why. It's scarce in the ground. It's difficult to find. it's impervious to the elements, which means it survives, and it's malleable, which means it's easy to make into coins for currency. And it's man's oldest and most trusted form of money and currency, going back from ancient times all the way to World War II. And what gold really is compact, transportable, transferable wealth. 100 ounces of gold is about the size of a paperback novel. It weighs about 8 pounds, and you can carry it around in your pockets pretty easily. And today that value is about $240,000. So literally you could carry around in a paperback novel-sized form, almost $250,000 in your pocket, and no one would know you have it. That's the transferability of it, the transportability of it, and the compactness of it. And I think the reason it's in a lot of demand today in particular is because it has no counterparty risk. Gold is an asset unto itself. It's recognized around the world. It's liquid anywhere, anytime you present it for sale to a reputable buyer. And its value is not contingent upon a counterparty performing, like a company producing profits for a stock, or if you have rental property, like I know a lot of you do, and you have tenants, if your tenant doesn't pay the mortgage, well, you have to. That's counterparty risk. And gold also tends to retain its purchasing power over time. So it's a great way to save money outside of a depreciating dollar or a depreciating currency. So if you want to have a savings account, you might consider having precious metals, gold or silver, as a better way to save instead of putting dollars in the bank. So those are gold's attributes. I just love this picture. This shows how old gold's history is. This is King Tutankhamun, or King Tut's burial mask from 2500 BC. It's got 22 pounds of pure gold in it. And that's very cool looking. These are coins that have been made since the 1800s that were used as currency when gold was currency and money. Now, money and currency are two different things. Money is something that has value. Currency is something that we use as a medium of exchange. And up in the top left is a picture of Napoleon Bonaparte. And that's a 40 franc French coin from 1801. Down at the bottom, the two bigger coins are US $20 gold coins minted from 1850 to 1933, when gold was money and currency. Now gold is not currency anymore. So this is the basic time frame for gold as money and currency. From ancient times until 1945, gold was both. Then after World War II, gold went out of the money system as currency, but the dollar became the world's reserve currency because we survived World War II better than any other country on the planet, and we had more gold than any other country did. So the world made the dollar the world's reserve currency, but to give it the trust that gold as money had before and currency, they backed the dollar by gold. So the US was not supposed to print any more dollars than we had gold in Fort Knox to back it. And that lasted only about 26 years until 1971, when Richard Nixon famously took the US off of the gold standard and the dollar became fiat currency, which means it's backed by nothing but the full faith and credit of the US government. Well, that's a pretty good backing as long as you run your finances well. But what happened in the 70s is we went through an inflationary bout. We had a couple of oil shocks. We had some instability in the financial system. And we're going through a similar period now to the 70s with inflation. We've got war in two different countries. And we've got debt that's just growing like crazy. So I'm going to go through some charts next that'll show you how the gold price has performed in these different eras. So this is a gold chart from 1968, bottom left, to 2006, 2007, top right. It's a logarithmic scale, which means it's not equal as you go up, but it shows how gold went from about $40 an ounce when Nixon took us off the gold standard in 1971 to over $800 an ounce in 1980 as we went through the inflationary 70s, We had a couple of oil shocks, and there was instability in the financial system. So gold went up 20 times in value during that period of time. Then we had stability come into the markets. And for the next 25 years, gold traded primarily between $500 and $300 an ounce. That's most of my career leading into 2005, 2006. So this is a chart of what's happened in the 21st century. Excuse me. Now, these lines across the chart, the green and red lines, are support and resistance lines, and they define different price levels where gold is traded above and below for periods of time, kind of like Guy's, charting on his platform. So from the mid 80s to 2006, gold really didn't hardly get over $500 at all. We were attacked at 9/11. We went into deficit spending. We went into war in Iraq, and the gold price started to surge on the back of that. And then we hit the financial crisis in 2008. And that's when deficit spending accelerated in earnest. And that took the gold price up to about 1,050. And then the government turned the printing presses on in earnest in response to the great financial crisis of 2008. Quantitative easing was created, where we created $2 trillion of new debt out of thin air because politicians could turn the printing presses on, which was impossible when gold was currency. And they dropped interest rates down to zero. And that turbocharged the gold price up about 6 times in value, from $300 all the way to $1,900 by 2011. So while the crisis was in full bloom, the gold price stayed up about $1,650 to $1,850 per ounce until the world's economy got a little bit of traction in 2013. And that's when we saw a pretty big correction in price back down to a trading range between 1,050 and 1,375. That lasted for 5 or 6 years. And now the gold price has taken off again in following the COVID explosion of 2020. Gold popped up to 2070. And now we're just recently have run from triple top at 2050, 2070, all the way to just about $2,400 an ounce as we've gotten into, increased debt, inflation, and war again, another period of instability. So one of the main fundamental drivers of this higher gold price, which is lumpy, as you can see, gold can get a little ahead of itself and get a little behind itself at times. But what is primarily tracked over all this time is the growth of U.S. debt over the last 20, 30 years. You can see on this chart, which shows U.S. debt, in 2002, our debt was about $5.7 trillion, and it took us 200 years to get there. Then between 2004 at $7 trillion in debt and 2014, a 10-year period, our debt more than doubled to 17 trillion. Now it's 10 years later, and our debt has doubled again from 17 trillion to almost 35 trillion today. And that begs the question, where is our debt going to be in another 10 years? Is it going to be 68 trillion, another double? Well, nobody knows. But it's a pretty sure bet that our debt's going to go higher, and perhaps substantially higher. And remember, this is multiples, 6 or 7 multiples of what it took 200 years to get us to in the first place. So our debt is accelerating at a rapid pace. And that's why gold is becoming more attractive to people all around the world, because we're debasing our currency by just producing more and more of it. And not only is our debt going up, now our interest payments are going up as well. We used to pay about $500 billion in interest on our debt, but now that the interest rates have gone up so much in the last year or two because the Fed's fighting inflation, our annual debt service payment is now over $1 trillion. So we're getting into a bit of a debt spiral where the debt keeps increasing and the debt service is growing exponentially as well. And this is not good for the dollar. It's certainly not good for the United States. But right now, there's no end in sight. The problem is we're not the only country that's going through this phase. This is a global debt chart It starts in 2014 and goes to 2021. When we started this on the back of the great financial crisis, the global debt was about 220 trillion. And as of 2022, we're up to 290 trillion. So everyone around the world is just increasing their debt. All the governments of the world are at a rate faster than we've ever seen before. You know, in the 70s, the US was primarily growing its debt faster during that inflationary period. Now, during this period post the great financial crisis, everybody's doing it. And it's only in the last 6 months or so that we're starting to see some real worries about this exponential debt growth, which is being reported in the mainstream financial press. This is a story I got off of Bloomberg on April 1st. 1 million simulations, one verdict for the US economy: debt danger ahead. Bloomberg economists ran 1 million forecast simulations on the US debt outlook. 88% of them show borrowing on an unsustainable path. Now, none of us could do this personally because we don't have printing presses, but the government can. But this is a bigger problem when you look at other things. This report came out just the other day. This is from the Washington Post. Social Security and Medicare finances look grim. Social Security will be insolvent by 2035. That's just 5 years from, that's just 11 years from now. And Medicare by 2036. Now, they used to say this would go till 2040, 2050. Now the time frame is compressing, and it's getting closer that we will have problems with our two largest entitlement programs. I know from working with the government on a couple of precious metals cases for fraudulent dealers that the government doesn't like to fix things till they break. And something big could break in the future, which is why gold is becoming more and more favored. It has no counterparty risk. So let's take a look at the gold chart again. This is a 20-year gold chart. It's the same chart I showed you earlier, but you can see the trend lines. It's higher, higher, higher over time. And we're in a phase right now where gold may be breaking out to the next higher trading level. And things are happening quickly. If you had asked me back in 2019, when the gold price was still under $1,300, it's about $1,200, when I thought gold might break $3,000 an ounce, I would say, oh, that's going to be years from now, and that's a really aggressive target. Well, now it's just 5 years later. Gold's $2,400, and $3,000 gold doesn't seem that far off to me now, because there are other drivers besides just our debt increase that is pushing the gold price higher. And these are the primary drivers overall. So we talked about debt. That's a fundamental driver that's not going to change. We're seeing central banks around the world have become record buyers of physical gold over the last 12, 13 years. This is a big trend change, and it's very fundamental. And there's a couple of reasons why, and debt is one of them. Remember, central bankers are the ones that have the printing press. They know what they're doing, and they're buying gold as a hedge for themselves against counterparty risk of other governments. There's also a de-dollarization move afoot with the BRICS countries, which is a new fundamental that'll take time to fully develop. I'm going to touch on it a little bit. So these are three fundamental drivers, and there's some variables as well. There's economic and geopolitical instability. You know, gold tends to climb a wall of worry when there is instability, either economically or geopolitically. There's currency debasement, which is, continued debt, which can create an inflationary bout like we're going through now. That's a variable because that can come and go. And gold also has an inverse correlation to the value of the dollar against other currencies and against treasury yields or interest rates. Because if you can get money by putting money in the bank, if you get a 5% return, well, gold doesn't offer a return at all. So when yields are higher, gold tends to not do as well as when yields are lower or below the inflation rate. But this is more of something that moves the gold price around on a daily or monthly basis. What I do want to talk about a little bit more are central bank buying and selling habits, because that's a big fundamental driver right now that most people are really not that aware of. This is a chart that goes back to 1950 that shows central bank buying and selling, net purchases and net sales. So anything under zero are net sales, anything above zero are net purchases. And you can see for most of the time frame from 1950 till 2010, the great financial crisis, central banks were net sellers of gold, except for a little bit during the inflationary period that started in the late 60s and went into the 70s. But since the great financial crisis, central banks have been net buyers of gold, and they're the most conservative bankers on the planet. And not only that, we're seeing big buying from the public as well, but not in the US. Now, China in particular has been adding gold at a record rate over the last decade, both from the government and from the public, especially in the last couple of years because of what's happened with the Chinese economy. The Chinese populace, they have investments in property, they have investments in their stock market, and they have precious metals. That's basically the three places they can go. And because of the COVID problem, the property market's not been doing well at all. That's from overbuilding. But the stock market's not been doing well at all. So they're buying physical gold at a record rate, both the populace and the government. And this is another story from Bloomberg that reiterates that. Well, this is what really snapped my head when I saw these statistics. Excuse me. Central bankers have been buying on average between 2011 and 2021 about 500 tons of gold annually, cumulatively. That's about 20% of mining production. So the mines make about 2,500 tons of new gold every year. They're pretty consistent in that number. And central bankers suddenly, since 2011, have been buying about a fifth of that mine production annually. In the last 2 years, 2022 and 2023, that's doubled to over 1,000 tons a year that central banks are buying physically, taking metal out of the market. That's now 40% of mining production. And why have they ramped that up? Well, Russia invaded the Ukraine, and we sanctioned Russia. We penalized them in the financial system. We seized their assets, and we kicked them off of the SWIFT international bank transfer system. We've made them a pariah financially. Well, governments around the world have said, hey, if they can do it to Russia, the US can do it to us. So if we have money in their markets, or if we have their treasuries, or if they have assets that they can seize, well, we can't protect ourselves. But if we have gold in our vaults, they can't sanction that and they can't seize that. And that's why suddenly central bankers are buying a lot more gold in the last 2 years than they bought over the last 12, and they've been buying a lot over the last 12. So this is a big fundamental trend. Now, you also have the BRICS nations coming to power. Brazil, India, Russia, China, South Africa have added a couple other countries in just the last year. The yellow countries are oil producers, the biggest oil producers on the planet. And the red countries, India and China, are oil consumers. So now you have some of the biggest oil producers and the oil consumers on the planet doing business with each other outside of the dollar for the first time, because from 1974 until 2020, oil was priced exclusively in dollars. Now these countries want to do more and more business with each other and not use the dollar, which is fundamentally inflationary for the US in the big picture. I don't really want to dwell on it here, but this is a trend that's going to continue to grow. It's the third big fundamental, but it's developing. It'll take time to grow further. But here's MBS with Putin, the head of Saudi Arabia. Here's MBS with Xi Jinping. And just today, this picture popped up of Vladimir Putin visiting Xi Jinping in China. And these two are working together to help to destabilize the US. The war in the Ukraine is a way to cost the US money. So they're trying to create a block on the eastern side of the world to the detriment of the US. And if you look at the BRICS countries together and their applicants, they have greater gross domestic product than either the United States or the Eurozone do individually. So this is a force to be reckoned with as time passes. So now let's look at a gold chart going back the last 6 years. And this encompasses most of the drivers that I've been talking about. Now, when gold was under 1375, at that point in time, the federal funds rate was about 2.5% in 2018 going into 2019. And then the Fed cut rates in response to a global economic slowdown. And that caused gold to get over 1375 again for the first time in 6 years. Then COVID hit and we had some economic instability. And then we started turning on the printing presses again. We created 6 trillion of new debt in 2 years, and gold ran all the way up to 2070, where it hit a top. It stabilized between about 1800 and 1950 for the next year or so. Then Russia invaded the Ukraine and gold popped up again to about 2070. Then, in response to inflation, the Fed raised interest rates aggressively from about 0 to 5.25%, 5.5% where we are today. And that created a much stronger dollar against other currencies. That caused the gold price to go down. That's the inverse correlation. That's the strong USD on that chart when gold hit about 16.25 2 years ago. Then that naturally ebbed, the dollar lost in value, gold regained value. And then the SVB bank failed. And we had a couple other bank failures a year ago because banks not used to higher interest rates didn't manage their treasury positions properly. And that caused some instability in the banking system. Gold got back up to 2070. And during this time, that's when central bank buying doubled, right? And then Hamas attacked Israel. And gold has broken over a triple top to a new all-time high of a little over 2,400. And it's based on most of these factors. Growing debt. We've got geopolitical instability, 2 wars, record physical demand. Now, what happens if we go into a recession and the Fed's forced to ease and drop yields? Well, that will buoy the gold price higher. What if they have to stimulate the economy by creating more debt? Well, that will grow our debt even faster. This is all good for gold, sadly, but that's the reality of the situation. So I think the fundamentals are in place, big fundamentals, to drive the gold price higher over time. And perhaps more quickly than we realize. And then there are some extraneous factors that could come and go. You know, inflation could ease a bit more from here, I think, but it may be proved to be more stubborn than the Fed realizes. So this is a gold chart again. You can see the trend line. And keep this time frame into perspective. Look at that $1,900 peak. And then see how gold has set a new high again just in the last couple of years. Let's go to silver, that I think is an even better opportunity than gold going forward. This is a a silver chart going back to 2020. Silver lags and then follows gold. And when it plays catch up, it tends to do so with a vengeance. And that's exactly what this chart shows. As gold was going from $1,000 to almost $2,000 an ounce, $1,900 between 2008 and 2011, silver lagged for most of that time. And then when it played catch up with a bullet. And it got to almost $50 an ounce, which was the same price silver was back in 1980 when gold hit $850 an ounce. I showed you that earlier. So silver's been up to $50 an ounce twice in the last 40 years. But today, it's still about half of its previous 2 all-time highs, while gold is setting new all-time highs. And I think silver, when it plays catch up, it'll do so like this again, but it hasn't done it yet. It's starting to try to. That's why I think silver is an even better opportunity. Here's a 6-year chart that shows the price action similar to the gold chart I showed you a moment ago that showed those drivers on it. And for most of the last 6 years, you know, silver's been either under 18 until it broke out on the back of the COVID response. It got to 29 on a bullet. So that was a big gain, but then it's channeled. Now gold has gone from 2050 all the way to 2400, and silver still really hasn't broken out, but it's just starting to. That tick over 29 that's highlighted in yellow in the upper right-hand corner, that's just yesterday. So I think if Guy was looking at his chart, he would like this right now as a setup. And I can't dispute it. I think silver's trying to break out and start to play catch up. I normally don't think there's a lot of urgency in these markets, but silver could get away from us pretty quickly here. So the opportunity may not last as long as I might like it to. Here's another way we measure this is the gold to silver ratio, how many ounces of gold, how many ounces of silver it takes to equal 1 ounce of gold. Today, the ratio is about 81 to 1, which is extremely high on the chart. And you can see where the two blue ellipses are, that's when silver has played catch up. That's that big spike in 2011 when the ratio dropped from about 84 to 1 down to 32 to 1. That's silver playing catch up to gold. And then the second one is when silver went from 18 to 29 just during the COVID expansion of debt and the gold price running hot fast with silver playing catch up a little later. So I think this ratio at 81 is very high. 65 to 1 is an equilibrium point. 48 to 1 is silver's expensive relative to gold. I think this ratio could drop to about 65 to 1 pretty easily, which would put silver in the $40 range, depending on where the gold price actually is. But silver to me looks like a great value. So I'm a physical dealer. I deal in the physical ounces themselves. I'm going to go through this a little bit quickly. These are the cost factors that impact the manufacturing of the metal. You've got to have the metal. You've got to make a blank. You've got to make dies to strike the coins. They're made in volume. They go to a distributor that then go to a dealer like me who sells to the public. We all make a small profit along the way, but it's still a very competitively priced market. This is probably the most important slide I will show you if you want to get into the physical markets. Choosing your dealer is extremely important. You want to find someone who's trustworthy, reliable, with a great reputation, longevity in the market. You want to know what their affiliations are. You know, I'm a member and a past president of the Professional Numismatists Guild, which is the leading organization of rare coin dealers in the country. We tend to be the cream of the crop in the industry. Look for reviews and referrals. Then you want to think about what metal is right for you, what product might be right for you, what's your goal. This goes back to what you said earlier, Sarah. You wrote down your goals and it changed your life, right? So the same thing here. You want to hedge against uncertainty. Do you want to save money outside of a depreciating dollar? Do you want to have some hard money, which silver is good for if there's a crisis? Do you want to be able to transfer wealth easily and privately? What's your holding period? What is your exit strategy? I'm going to run through the physical products pretty quickly that we deal mostly in. We deal in US Gold Eagles, Canadian Maple Leafs, and Austrian Philharmonics. This is what we do most of our business in. If this was ice cream, they'd be vanilla, chocolate, and strawberry. Simple as that. We do 95% of our business in those 3 1-ounce gold coins. And we also do a bit of business in Swiss gold bars. So here's a picture of a gold eagle. Here's a picture of a maple leaf. It's got King Charles's picture on it instead of Queen Elizabeth since she's passed away. These are Austrian gold Philharmonics. These are 1-ounce gold Swiss Pamp bars. In silver, it's the same thing. We recommend US Silver Eagles, Maple Leafs, and Philharmonics from Austria. We also recommend 100-ounce bars. Again, here's pictures of them so you know what they look like. Silver Eagles come to us in boxes of 500 per box from the mint. It takes a lot more storage to store silver than it does gold because it takes 80 ounces of silver to equal 1 ounce of gold. So this 500-ounce box is about the size of a pair of cowboy boots that you would buy from the store. That's about how big the box is, and it weighs about 40 pounds. So you've got to think about storage, especially if you're buying bulk silver. Here's a picture of a maple leaf again. Its box of 500, Philharmonic. We also do some business in 100-ounce bars. They're more compact. You can fit 5 of them in a much smaller area than one of those monster boxes of 500 Silver Eagles or Maple Leafs. Also, there's only one manufacturing charge for a 100-ounce bar versus 100 manufacturing charges for 100 1-ounce coins. So some 100-ounce bars tend to have a little bit tighter buy-sell spread or more competitively priced as a result. You've got to think about your storage options, where you want to keep it. We recommend private storage facilities. We have a list available. And then you want to think about best practices. You want to buy only mainstream, widely traded, competitively priced items, buy-sell pricing, stay away from online auction platforms or private sales. That's where you get into trouble, and avoid lost leaders. Take delivery. The good news is I've got a lot of this physical information in our Getting Started guide, which you can access through the QR code here. Just put your email address into our form and just put Getting Started guide in the comments, and we'll send you our Getting Started guide. You can also subscribe to our YouTube channel if you want to follow what's happening in the gold price. I put videos out about twice a month. And in conclusion, I'd just like to say a little gold goes a long way. A 6 to 8% allocation offers mitigation of risk from traditional asset volatility. It gives you enhanced portfolio profitability. Over the last 20 years, gold has averaged about 8% every year annually. As I showed you in the charts, it's lumpy, but this is in every currency in the world. Every currency. It's a deep and liquid market. And I would suggest you think of gold as a way to save money in lieu of saving dollars. So that's the end of my presentation. Hope I didn't go too long. I think I might have gone a few minutes over.
You're all good, Dana. The chat was blowing up. People really liked what you had to say. Lots of thought-provoking stuff as you connected gold with everything else that's going on in the world. And we have, I think, 2 more speakers today who are going to speak about gold, but in a different capacity, in a different way. So I think it's fun to see how it all fits together. So I appreciate it.
Thank you. Thanks for having me. I'll be around for the Q&A a little later. Happy to help anyone we can.
Perfect. We'll see you then.
All right. Thank you,
All right.
Savannah.
Yep. Up next, we have Colin. Colin, go ahead and feel free to turn on your video. And good morning. You're over in Hawaii, right?
No, not anymore. Last time we spoke, I was in Hawaii, but no.
Okay.
Nice to see you, Sarah. Thanks for having me on. Very excited to be here and jumping on a little earlier than I anticipated, but I was excited to get rolling here.
Yeah, I appreciate that. Yeah, there was a last minute change by one of the other speakers.
No
So we have been speaking about, the different speakers have been like all over the place. We're really covering a broad base here. And now we're going to switch. We were talking stocks, options, gold, and now it's kind of like the opposite of gold, crypto. So I'm really excited to hear what you have to say, and everyone in the audience, really think about how what you're about to learn can blend into what you're already doing or replace something that you're doing that isn't particularly useful or profitable anymore.
Yeah, exactly. And I appreciate hearing about gold right before I get on, because I'm a true believer in alternative investments, and also in the gold space and another business. And part of the reason I started My Digital Money was because I knew that cryptocurrency was still the Wild Wild West. And we've seen a lot of things happen over the last few years to kind of prove that to be true, with FTX and different things that are happening. So I wanted to create a safe platform that had online support and a phone that you could call and talk to somebody here in the US.
Amazing.
Yeah, exactly. And we wanted to make sure that people, if they took this leap of faith into something like cryptocurrencies, that it was done in a safe way. And obviously wrapping it with the tax advantages has been fantastic. So we've been in business for a little over 3 years, no data breaches, and a lot of very happy clients, just because of the way that we've set up the business. So for any of you that are getting started, I'm excited to be here. I'm Colin Plume, CEO of My Digital Money. We're a cryptocurrency trading platform that allows you to buy it directly or in an IRA. And in essence, why are we here, Sarah? We're here because time's running out. We're investors. We want to catch up financially, and we're looking for a cost-effective, efficient, and least risky option
Yep.
to have financial freedom.
Always.
As Warren Buffett says, Sarah, I can buy anything, but I can't buy time. And I think that's really what we're talking about today is how to maximize your returns in the safest possible way.
Yeah,
I'm
I
going to show
love-
you.
Yep.
Yeah, go ahead.
Okay. Oh, I was going to say that really ties into my opening around, like, we all want to grow our wealth, but if we have to spend 12 hours a day doing it, we're not going to enjoy our wealth. So
Correct.
figuring out how to do it in a low time consumption format and in a safe, lower risk way is just as important.
Yeah, absolutely. And you know, I'm a true believer in diversification. I do own what you offer, syndicated apartments, and I own triple net properties. As I've grown into the space in the last 20 years in alternative assets, the one thing that has really been affirmed is that alternative assets are actually the only way to get to a healthy retirement in my eyes. I think that the mainstream returns are not going to get you where you need to go anymore. And we're seeing it in many different avenues. But I'm going to talk about one way to achieve some success.
Awesome. Take it away, Colin.
Absolutely. I'm going to talk about something you may have come across before. You thought about, it's clever. You know, it's something that potentially could save your ass in essence. And even if you have no interest in crypto, you think it's scammy garbage, give me a half an hour and let me try to explain why you should seriously look at this part of your diversification and you should be building it into your retirement planning. Today, we're going to be taking a journey through time, exploring the concepts of compound interest, the benefits of crypto IRAs and 401ks, and how you can use these powerful tools to secure a brighter financial future. Before we dive in, let me share a story with you. Imagine you're Marty McFly, classic movie from Back to the Future, riding in the DeLorean with Doc Brown. And actually, the 40-year anniversary of this film is coming up next year, and it's sort of framed my discussion here, and mostly because I love this movie. As we all know, Hollywood glosses over the tough bits. It's all very well traveling off into the future and having no job when you get there, and you're going to retire in 2040 or 50. But how are you going to pay for this fun and this adventure? Lots of us are in this position. You're probably wondering what all this has to do with the film. Back to the Future is a very clever film. It offers a rich tapestry of lessons that extends far beyond its entertaining plot and special effects. Through the adventures of Marty McFly and Doc Brown, the film explores themes deeply rooted in human experience, providing insights into courage, family, adaptability, and the consequences of our actions. So one of the things we're going to discuss is the courage to overcome fears. Both Marty and his father, George, face their fears and emerge stronger. Marty learns to confront his fear of rejection while George stands up to this bully, Biff, and they change the course of his future. This lesson in courage is the central theme to the movie. And cryptocurrency can be just like this. It might be so far out of your comfort zone that the thought of investing it fills you with dread. But I'm going to show you how you can minimize your risk with crypto. And as we know, fortune favors the brave. The film cleverly uses the time travel to illustrate how even small actions can be significant impacts on your future. Marty's interference in his parents' courtship nearly erases his existence, underscoring the butterfly effect of our decisions. Nothing shows butterfly effect more than the idea of compound interest. And I'm going to come to this in a minute, but compound interest is a way of taking very small action early and watching it grow with momentum. Warren Buffett said recently the majority of his wealth was made in the later years of his life. But what if you didn't invest in those early years? You have to do some creative problem solving. Marty and Doc's adventures underscore the importance of being adaptable and finding creative solutions to problems, whether it's finding a new power source to the DeLorean or ensuring Marty's parents fall in love. The duo's ability to think on their feet is crucial to their success. The film shows the need for agility in learning and development. Learning something new like you are today in crypto can help accelerate your wealth, but then using the creative tax solution I'm going to show you to compound your growth. We're going to bend time so you can get to the end quicker, which is what everybody wants. So, big question, why crypto? Now, you may be thinking, crypto, isn't it a bunch of digital mumbo jumbo? And believe me, I understand your skepticism. Cryptocurrency has gotten a bad rap over the years with stories of scams and hacks, wild price fluctuations dominating the headlines. But the truth is that when it's approached with knowledge, caution, and a long-term perspective, crypto can be a powerful tool for growing your wealth and securing your financial future. Now, before we dive in, let's take a moment to appreciate the incredible growth of cryptocurrency market over the last decade. 10 years ago, not that far away, only a handful of early adopters owned cryptocurrencies. Fast forward to today, and it's estimated that over 420 million people worldwide own some form of cryptocurrency. That's a staggering increase of over 58% in just one decade. And experts predict that the number will continue to grow, with some estimates suggesting that over 1 billion people by 2030, in the next 5 or 6 years, will own cryptocurrencies. Now, countries as China and India have taken a more cautious approach to crypto assets. In China, the government has banned initial coin offerings, or ICOs, and has cracked down on cryptocurrency exchanges and mining, citing concerns over fraud and financial instability. In India, the Reserve Bank of India has prohibited banks from dealing with crypto-related businesses, citing concerns over money laundering and terrorism financing. Despite the varying levels of adoption and regulation, the overall trend towards adoption of crypto assets globally has been very positive. The growth rate of global retail adoption has increased 87%, and you can see it in this chart that we have here. It's pretty unbelievable. So what is crypto? That's the big question. What exactly is it? And why has it gained so much popularity in the recent years? Put simply, cryptocurrency is a digital or virtual currency that uses cryptography for security. The most well-known cryptocurrency is Bitcoin, but there are thousands of other cryptocurrencies, often referred to as altcoins, each with their own unique features and use cases. One of the key features of cryptocurrencies is that they're decentralized, meaning they're not controlled by any government or financial institution, which is why a lot of people really like them. Instead, they operate on a peer-to-peer network with transactions recorded on a public ledger called the blockchain. This decentralization is what attracts many people to cryptocurrencies, as it offers a level of freedom and security that traditional currencies cannot match. So let's go over some of the myths in cryptocurrencies. Of course, with any new technology, there are bound to be myths and misconceptions. And I want to talk about the pros and the cons of what's happening in the market, and not just created that it's all a silver lining here. I want to give you guys some in-depth truth. So some of the common myths about cryptocurrencies. Cryptocurrencies are only used for illegal activities. Cryptocurrencies have no real value. Cryptocurrencies are a passing fad, and cryptocurrencies are too complicated for the average person to understand. So let's address some of these myths sort of by one and break them down. First, well, it's true that cryptocurrencies have been used in the past for illegal activities. The same can be said for traditional currencies. In fact, the transparency of the blockchain makes it easier to track and prevent illegal activities than with cash transactions. Second, cryptocurrencies do have real value, just like any other currency or any other asset. The value of a cryptocurrency is determined by the market demand, just like the value of a stock or a commodity. Third, while the cryptocurrency market is known for its volatility, the technology behind cryptocurrencies, particularly blockchain, has proven to be far more than a passing fad. Many experts believe that blockchain technology will revolutionize industries beyond finance, including healthcare, supply chain management, and much, much more. Finally, the technical details of cryptocurrencies can be complex. The basic concept is actually quite simple. Just like you don't need to understand the inner workings of the internet to use the internet. You don't have to be an expert to buy, sell, or trade cryptocurrencies. The future of crypto, looking ahead, the future of cryptocurrencies, particularly Bitcoin, looks bright. Many experts predict that Bitcoin could reach over $1 million or more within the next 5 to 10 years. The main reason analysts believe this is Bitcoin has a limited supply. Limited supply of Bitcoin is that it's only going to have 21 million coins. And as of March of 2024, over 19 million of these have already been mined. So the remaining is about a little less than 2 million coins. And the last coins are estimated to be minted by 2140. So obviously the mining of Bitcoin will slow, but there is a limited supply, which people really like in terms of investment, similar to gold. Some even believe that Bitcoin could eventually replace gold as a store of value, given its fixed supply and increasing adoption. Let's talk about the blockchain. Bitcoin is just the beginning. The real potential of cryptocurrencies lies in the underlying blockchain technology. Imagine we have a digital book that anyone can write in, but no one can erase or change what's already been written. That's like what a blockchain is. In a blockchain, information is stored in blocks and they're linked together in a chain. Each new block connects to the previous one using a special math formula, so you can't change the order or content of the blocks. It's an unbreakable chain. One cool thing about blockchain is it lets people trade and interact directly without needing a bank or a middle person. The math and code in blockchain make sure everyone is secure and that nobody cheats. Blockchains work using a web of computers all over the world. When someone adds a new block, all these computers quickly work together to make sure that it's correct. They check the rules, they do a mathematical formula, and then it adds to everybody's chain. So there's no central controller. And you can trust the blockchain itself rather than any one person or any one company. And that's another great attribute. Blockchains can be used to create digital money called cryptocurrency or crypto. And the blockchain acts as a super secure bank vault and account book. It can prove you own the cryptocurrency without needing to actually show it to anyone. Programmers are building lots of apps and systems on top of blockchains too. By cutting out the middleman, blockchains can make things faster, cheaper, and give power back to regular investors and users. Blockchain has the potential to revolutionize the way we conduct transactions, store data, and interact with other people online. For example, Ripple, a cryptocurrency designed for banks and payment providers, is already being used by major financial institutions to facilitate cross-border transactions more efficiently and securely. Ripple is currently available on My Digital Money after a long court case with Ripple with the SEC, and it's currently trading at about 52 cents. A blockchain technology continues to evolve. We'd expect to see even more innovative cases emerge. From smart contracts that automatically execute when certain conditions are met, to decentralized applications, crypto and blockchain regulation, and of course, the widespread adoption of cryptocurrencies is not going to be without its challenges. One of the biggest hurdles is regulation. Government around the world is still grappling with how to regulate cryptocurrencies, and the lack of clear guidelines has caused uncertainty in the market. So this brings us to an interesting question. This is the big question I get all the time. Could countries decide to ban cryptocurrencies altogether? Certainly possible, and I've seen many countries, such as China, take steps in this direction. However, many experts believe that outright ban on cryptocurrencies would be difficult to enforce, given their decentralized nature. In the case of the United States, it's unlikely that we'll see a complete ban on cryptocurrencies anytime soon. In fact, the US government has taken a relatively open-minded approach to cryptocurrencies, with the IRS even providing guidance on how to report cryptocurrency transactions on your taxes. However, that doesn't mean the road to mainstream adoption is going to be smooth. One of the biggest challenges facing crypto today is scalability. The current infrastructure of most cryptocurrencies, including Bitcoin, can only handle a limited number of transactions. This has led to slow transaction times and high fees during periods of high network activity. To address this issue, many cryptocurrencies are working on scaling solutions such as Lightning Network for Bitcoin and sharding for Ethereum. These solutions aim to increase the number of transactions that can be processed per second while still maintaining the security and decentralization of the network. Crypto acceptance and adoption. Another big challenge is adoption. While the number of people owning cryptocurrencies has grown significantly, we're still a long way away from widespread adoption. So for cryptocurrencies to truly go mainstream, they need to be easy to use and accessible to everyone, not just tech savvy and early adopters. This is where the role of crypto ETFs has come in. Crypto ETF or exchange traded fund allows investors to gain exposure to crypto without having to buy it directly. This makes investing in cryptocurrencies interesting, particularly those that are uncomfortable with some of the technical aspects of investing in cryptocurrencies. Canada approved the first Bitcoin ETF in 2021, And now the US, after a long battle, they've actually just approved their first Bitcoin ETF. They started in 2013 and it just got approved in January. And you saw the cryptocurrency market react very positively to cryptocurrency. And that's why we've seen a massive run up in Bitcoin. One of the reasons is we've seen a massive run up in Bitcoin. So having an ETF available in Bitcoin is opening the market up. It's allowing companies like BlackRock and a lot of these companies that didn't have access to it be able to trade it. Now, the pros of the ETF is it does open it up to a wider market. It allows these big stock trading firms to sell it. Some of the downsides is you're only going to buy that one crypto. Also, there's fees every time they trade in and out. There's fees to buy it on top of just owning it directly. So it does open it up. It does help investors that own cryptocurrency, but overall, it does lack flexibility. The fees can be high. And most cryptocurrencies experts or enthusiasts typically want to own it themselves. They want to have control of it. They want to be able to have it, and they want to be able to move in and out of the market with lower fees, which is part of the reason that I started MDM and My Digital Money, is because I wanted people to have direct access. I knew ETFs were going to come, but also having direct access to diversify makes a lot of sense too. A lot of times people, when they sell their Bitcoin, they do not want to go back into cash. So having some flexibility to go into other cryptocurrencies and move in and out is some of the pros of going on an exchange as opposed to an ETF. So do keep that in mind. But big picture, the launch of the Spotcoin BTF is a major milestone in the mainstream adoption and legitimacy of cryptocurrencies, and making it more regulated and available to more people is a pro. On the first day of trading, the new ETFs saw a massive influx. There was $4.6 billion in volume. So that is something to keep in mind. It has pushed the market. They are talking about having an Ethereum ETF that they're working on. Has not been approved yet. And actually, there's questions that the SEC will allow it. They're saying potentially that Ethereum could be a security also. I don't see how that would work, how that makes sense. But the SEC is talking about restricting that ETF. So could be a long time before the top 10 cryptos have ETFs, which is another reason it makes it difficult to invest that route. Crypto as a national international currency is coming. As cryptocurrencies and blockchain technology continue to evolve, one of the most intriguing possibilities is the concept of de-dollarization. The idea that cryptocurrencies could eventually replace traditional fiat currencies like the US dollar. In the last speaker, he talked a lot about many countries and the BRIC countries moving away from the dollar. This is happening. So even though it seems far-fetched that the dollar could lose its status, countries are getting prepared for it. So El Salvador last year, for example, was the first country in the world to adopt Bitcoin as a legal tender alongside the US dollar. That means that businesses in El Salvador are now required to accept Bitcoin, and citizens can use Bitcoin to pay taxes and other fees. Now, last year, Bitcoin was in trouble and went down, and a lot of people were actually saying it was a big mistake. Now, with a massive run-up of Bitcoin, El Salvador has done very well, very profitable. So it looks like they created a winning strategy. Ultimately, I think the idea of going away from fiat money and having a cryptocurrency like Bitcoin that has a limited supply does make a lot of sense, but actually instituting it is going to take some time. So a lot of countries are considering doing this, and it's moving. And this is the way of the future, is that countries, many more countries, I thought it was going to be an African country. I've been saying it for about 3 years. I was going to adopt it, but El Salvador has a very forward-thinking government, and they were the first ones to jump on it. And I think they're going to benefit in the many years because of this, forward-thinking adoption. It's a nice way, and it's a nice advantage to have another way for people in your country to transact business, because inflation is really hurting us. Now let's talk about something interesting with crypto and what's going on with investing, the power of compound interest. Let's turn our attention to how cryptocurrencies can be used to supercharge your retirement savings through the power of compound interest. Compound interest is the interest you earn on your initial investment plus the interest you earn on your interest. It's what Albert Einstein famously called the eighth wonder of the world. And for good reason. Over time, compound interest can help your money grow exponentially. To illustrate this point, let's consider two hypothetical characters, Alice and Bob. They both invested $100,000 at 5% annual return, but Alice started investing at 30 while Bob waits until he's 40. Fast forward to age 70, and the difference in their investment outcomes is staggering, just 10 years. Alice's investment, having an extra 10 years to grow, would be worth $704,999.78. That's right, over $700,000. Meanwhile, Bob's investment, which started later, would only be worth $432,000. And that's a difference of $270,000, simply because Alice started investing a decade earlier. This example perfectly demonstrates the power of compound interest and the importance of starting early. The earlier you start investing, the more time your money has to grow, and the more you can benefit from compound interest exponential growth. Now, how crypto, like Marty McFly, can bend time in 2024. So if you're like Bob and you start investing later, is all hope lost? Absolutely not. This is where crypto IRAs come in. Crypto IRAs are self-directed retirement accounts that allow you to invest in cryptocurrencies while enjoying the tax benefits traditionally associated with these types of accounts. Now, just to answer the question, you could have an IRA in crypto, you can have it in stocks, you can have it in a lot of things. So you don't have to put all your eggs in one basket. But by combining the growth potential of cryptocurrencies with the tax advantages of an IRA, you can supercharge your retirement savings and potentially make up for lost time. Let's start with the tax advantages. A traditional IRA, your contributions are tax deductible and your investments are growth tax deferred, until withdrawal. That means you can lower your taxable income in the year you put the money in, and you can let your investments grow without the burden of annual taxes. So if you're in the 25% tax bracket and you contribute $5,000 to your traditional IRA, you're going to save $1,250 that year. If you do a Roth IRA, you don't get the savings that year. You're going to get it at retirement, but you don't have to pay any taxes down the road. Harvard and many other studies have come out and said, if you could choose, you go with a Roth. So if you're in that position, you're choosing some of your money, I would always recommend a Roth IRA. It has more tax advantages there. So let's talk about tax advantages in a crypto ETF. Now, if you buy it with cash in a crypto ETF, you're not going to get these tax advantages. You really want to think about a crypto IRA. Many people today have massive gains in crypto, and they're really concerned about selling because they're worried about tax liability. So a crypto IRA is a way to avoid that tax liability until much later on. So let's talk about something that get into the details of it, of how it really works. So when you look at a crypto IRA, the thing you have to think about is that with My Digital Money, you're going to have up to 20 different cryptocurrencies. You can choose any of the ones that you want, a basket of them. But a lot of people will just start with Bitcoin and Ethereum. They have a longer track record, are generally considered less risky than smaller, lesser known projects. That said, even larger cryptocurrencies can have swings. So you have to have a long-term perspective, and you have to not let the short-term volatility rattle you. Let's go through some real-life success stories and cautionary tales. These are clients of MDM. I have changed their names to protect their privacy, which is something that we really value here at My Digital Money. First, let's start with Carol, savvy investor. She did her research, decided to invest $500,000 in Bitcoin through an MDM crypto IRA. Price of Bitcoin was around $43,000. Despite some temporary dips in the market, Carol held strong, believing in the long-term potential of Bitcoin, and her patience paid off. As of today, her investment has grown to $721,000, and it's a gain of $221,000 in less than 1 year. Then there's Dave. I said I was going to do the pros and cons. Then there's Dave. Dave was also interested in Bitcoin, but he let the emotions get the best of him. When the market experienced a downturn, Dave panicked, withdrew his funds at a loss of $125,000. If Dave had stayed the course and waited just a few more months, he would have had significant profits. It underscores the importance of educating yourself about the nature of cryptocurrency markets and maintaining a long-term perspective. These stories demonstrate the pros and cons of investing in IRAs and crypto IRAs. Carol was able to benefit from the growth of Bitcoin while also enjoying the tax advantages of a retirement account. Dave's experience reminds us that cryptocurrencies can be volatile, and it's crucial to have a long-term perspective and not make decisions based on short-term emotions. Now, how do we bend time with IRAs? Now, you might be wondering, how crypto IRA can bend time. And the answer lies in the combination of incredible growth potential and the tax advantages offered by these accounts. As we mentioned, if you're starting to save for retirement later in life, investing in a crypto IRA can help you catch up faster than a traditional investment vehicle. The extraordinary gains possible with cryptocurrencies, coupled with the tax-deferred or tax-free growth within these accounts. So let's talk about an example. Suppose you're 50 years old, you start investing in retirement, you have 50K to invest, and you decide to split it between a traditional IRA in stocks and a crypto IRA invested in Bitcoin. Let's assume, and you can look at this a chart we put out, let's assume that the stock market volatility returns about 7% annually, and Bitcoin returns 20% annually, which is conservative given its historical performance. After 20 years, when you're ready to retire at age 70, your traditional IRA would have grown to approximately $193,000. Not bad. But your crypto IRA, thanks to the higher returns of Bitcoin and the tax advantages of that account, will grow to a staggering $1,907,000. And that's a difference of $1.7 million, all because you decided to invest in a crypto IRA. Of course, I am talking about potential returns of 20% annually on Bitcoin, which is not guaranteed. Cryptocurrencies are volatile and past performance does not indicate future results. That said, even if Bitcoin's returns are more modest, let's say 10%, your crypto IRA would still outperform your traditional stock IRA, growing to $336,000. So that's what I talk about bending time. That's what I talk about Marty McFly and Doc Brown. By leveraging the growth potential of cryptocurrencies and the tax advantages of these accounts, you can potentially achieve much higher returns than with traditional investments, helping you make up for lost time and secure a brighter financial future. So how do we come in? At this point, you might be excited about the potential of crypto IRAs, but you're also feeling overwhelmed. This is totally normal. Most of our clients, they get excited and they start getting information. They start learning about what we do. They start getting our emails. They start trying to, talk to somebody, calling us live to get some information. This is totally normal. This is what you should be doing. You should check out our reviews. This information is going to continue to come to you, and ultimately you're going to make a decision if this is something that's right for you. The beauty about what happened today is that you guys took a leap of faith to come in and learn about something. And I really wanted to illustrate that there is pros and cons, because as we all know, you never hear about when anybody loses money. You always hear about when they make money. And I wanted to say that there is two sides to this. But if you're willing to learn and you are interested in learning about what we do, we have some comprehensive guides to crypto. We can talk about the different cryptocurrencies. We can talk about Ripple and some of the things that it does, which is some of the technology with Ripple is quite amazing. We have webinars, educational events, but ultimately today, what everybody did say was take a second to learn about what cryptocurrencies can do in your IRA. Hopefully it was helpful for people that are out there. And I will be available at the end to answer any specific questions you have about who we are and how it works. But also the biggest thing I would say is that you need to understand that security is a top concern for us, and it should be for you. There are a lot of hacks, a lot of scams. Most of the major exchanges have had this happen at some point or other. We have had none. We take security very seriously because we know if you take this leap of faith, and you have this massive gain, you want to make sure that your gains are there at the end. So make sure before you choose a platform that you look into this, you check their reviews, and make sure that they can help you in a way that you can be helping. A lot of companies have bots and people working in other places all over the world. We're a US-based company. My partner, Guy, and I own it. So you know who owns the business. We're not hiding behind anything. So if you're looking for a safe place to do it and you're looking to learn more, feel free to check us out at My Digital Money. And Sarah, thank you so much. Really excited to be here and talk about something that I'm so passionate about.
Yeah, I appreciate you being here too, Colin. And I think what you presented, it was so perfect because it was so clear and easy to understand, right? Everyone in the audience, there was no smoke and mirrors. It was like, here it is, nice and plain. So appreciate that.
Yeah. And if there is any questions that were not answered or, I'm ready for the tough ones in the Q&A. So fire them at me. And
all right, awesome. Looking forward to having you back at the
Q&A. Looking forward to the next two speakers. Thank you.
Thank you, Colin. All right, coming up next, we have Oh, whoa, look at that background. Hi, Jed. Hi, Corey.
Hello, everyone. How's it going? Yeah, you like the background? I hope it doesn't lag the screen out.
Oh man, I feel like woo.
Woo! Let me know.
I'm getting dizzy, Judd.
Oh, all right. So, audience, next up, following the crypto theme, but a little bit of a spin on making money in the mining and not necessarily on the thing. So we also talked about that the very first talk today. Matt Justice also talked about that with AI, investing in the support system of AI. And I believe that's what you guys are going to talk about as well. The support system of crypto might be just as profitable, less risk, more longevity, all those kind of things. So I love this concept, and I love investing this way. So thanks for being here, guys. I know we cut into your time a little, so I'll jump off and let you guys rock and roll.
Yeah, no problem. Thank you so much. And no, I think this is a good segue, following up on Colin's presentation, which I think he hit spot on in terms of discussing the value of the blockchain and the potential cryptocurrency. And I'm Judd Kitzmiller. I'm with NF&8 Group. I'm the operations director here. We raise money and mine Bitcoin at an institutional scale. What I'm going to be talking about today is more in-depth view with some more visuals on how the blockchain works, dive a little bit deeper into that, a little bit deeper into Bitcoin, the philosophy of Bitcoin, its true reason for its value, and then most of all, how we actually mine Bitcoin in the blockchain and what Bitcoin mining is all about. And then we'll bring in Corey.
Hi, my name is Corey. I'm the COO of NF&8 Group, and my segment will be about what institutional mining is all about. For those who have never seen what a true data center looks like internally, I'm going to take you on a little tour of our data centers located in Texas and throughout the Midwest. And we're going to be showing some videos as well, short videos. But I think you'll find it fascinating what true institutional miners and who they are and what they do and what our program is all about. So that being said, Judd, why don't you explain to everybody what is blockchain and what is mining? There you go.
Yeah, absolutely. So what you're seeing here, you see this as my background. This is our representation of what the blockchain looks like. You can see all of these algorithms coming down on these blocks that are all connected to each other. And when it lights up, we're viewing that as a block of transactions being verified using those algorithms that are being created by supercomputers that we call miners. And you're seeing millions and millions and millions of these algorithms solving these equations on the blockchain. So what I'm going to do, I'm going to dive into, again, giving a high-level overview of what the blockchain actually is. Our team actually put together a nice short little explainer video on blockchain and Bitcoin mining. It's like a minute and a half long. So I actually figured I could share that video real quick, and then we could jump into the rest of the slides. But I feel like they would be a kind of a good segue to go into it. I hope y'all can hear it.
Welcome, everyone. Today, we're about to embark on an adventure to demystify two terms that have been shaking up the world, blockchain and Bitcoin. Picture a colossal Lego tower. Each brick represents a piece of data, unique and significant. This tower isn't just a game, it's what we call a blockchain, in a chain of unique information blocks, each connected to the one before. This tower is visible to everyone. Once a brick is added, it's permanently in place. Let's use the example of a mayoral election. Each vote is a brick. There's no one central authority controlling the game. It's decentralized. Bad actors or malicious attempts cannot affect the blockchain. Imagine buying your morning coffee. With blockchain, your payment is a brick in the tower. This decentralization aspect of blockchain has made it popular across industries, banking, healthcare, supply chain, and more. Now let's talk about Bitcoin. But where do new Bitcoins come from? This is where miners come into the picture. They're contestants in an ever-evolving puzzle game. And the puzzle piece they're working on is a complex math problem, which is the final piece to that puzzle. Miners use powerful computers to make these guesses very quickly. When someone finally stumbles upon the correct combination, the winning puzzle piece, they shout it out to everyone else, and everyone agrees that they've indeed solved the puzzle. Every miner is rewarded. Every Bitcoin transaction forms a new puzzle piece, opening the treasure chest of new Bitcoins. And NFN8's powerful network of computers are the miners in this game, and your computer is one of these miners. Transparent, secure, and open to everyone. It's our democratic digital world. Well,
Yeah, so we thought that that gives a good visual on kind of a couple of images of what the blockchain, could look like, and how Bitcoin mining actually works. It is kind of like solving a puzzle when it comes to verifying these transaction blocks, which we're going to break down in more depth. But before we get into that, what is blockchain, right? So following up on what Colin said, imagine a digital ledger like a spreadsheet where transactions are recorded chronologically and publicly. Now, instead of this ledger being stored in one central location, it's duplicated thousands of times across a network of computers, often referred to as nodes. So think of Legos kind of in how they're pieced together, which we'll break down in a minute. So the key benefit of blockchain is that it's public and decentralized, right? So there's no central authority, there's no bank controlling it, controlling the ledgers. Anyone and everyone in the world can see it. No one person or authority owns it. We all own it. So transactions are grouped together in blocks, chained together, and each block contains a unique cryptographic code called a hash, which connects it to the previous block, hence forming a chain. And this chain of blocks is what gives the blockchain its name. And one of the key features of blockchain is its transparency. So since the ledger is distributed across the network, anyone can view it at any time. And this transparency helps ensure the integrity of transactions and helps prevent fraud. And once a transaction is recorded on the blockchain and it's confirmed by the network, it's extremely difficult to alter or delete. And this immutability is achieved through cryptographic techniques, making the blockchain, virtually tamper-proof. So we'll go back a little bit more into the essence of blockchain, go back to that tangible analogy, Legos, right? So much like Legos, blockchain is composed of building blocks that, when interconnected, form a robust structure with unparalleled integrity. And imagine each block is a digital record containing transactions or data. Just as Legos are interlocked to construct a structure, these digital blocks are linked together to form a chronological chain, again, hence the term blockchain. Each Lego block in the chain represents a set of transactions, a timestamp, and a reference to the previous block. So the Lego's strength lies in its immutability. Once a Lego block is placed, altering it or any preceding blocks requires disassembling and reassembling the entire structure. And this permanence ensures data integrity. And what that really means is that you can't change it. It's about downright impossible to hack or manipulate the blockchain. And just as building a Lego structure requires collaboration, blockchain thrives on a network of participants or nodes. And nodes are better thought of as supercomputers. And again, in the industry, we call those miners, which again, we'll get into in a little bit. But each computer has a copy of the entire chain, and that promotes more transparency. Just like you and your friends all had maybe the same instructions on building your ginormous Lego house, consensus among computers is needed to add new blocks, mirroring, the Lego analogy of unified construction. And while our Lego analogy illustrates the foundation of blockchain, its applications stretch beyond digital assets like Bitcoin. The security and transparency of the blockchain network allows major industries to leverage its foundation and, assist with supply chain management, medical record keeping, accounting, financial industries, construction, real estate, you name it. Some of the largest corporations in the world, such as IBM, Fidelity, Goldman Sachs, BMW, Walmart, many, many, many more are using blockchain technology right now. Not to go into politics, but I even saw RFK Jr. recently said that if he's elected, he wants to put the entire United States budget on blockchain. So it just goes to show there's really no end to what the possible use cases are using blockchain technology. So we've kind of given a high level overview of blockchain, or maybe went a little bit deeper, but now what I want to do is talk about Bitcoin and what it is, right? What exactly is Bitcoin? Now, it was actually created as a response to the 2008 financial crisis with the aim of providing an alternative to traditional banking systems and government-controlled money. So the creator, known by the pseudonym Satoshi Nakamoto, designed Bitcoin to be a decentralized currency. And that means it operates without a central authority, such as a bank or a government, and relies instead on a peer-to-peer network where transactions are verified by network nodes, supercomputers, miners, right? Through cryptography and recorded on a public ledger, you guessed it, the blockchain. So there's scarcity and supply, which has been touched on. There's a finite amount of Bitcoin. That number is 21 million. There's about 19 million in circulation. So there's 2 million more Bitcoin left to be mined, which will occur over the next 110 years or so, 2,140. But 99% of the Bitcoin supply will be in circulation by the year 2030. So there's scarcity in supply, and there's obviously increasing demand, and that's driving the price up. That's just simple economics. That's why it's being viewed as digital gold, more so being considered a commodity, but it's a commodity that you can liquidate to cash almost instantaneously, regardless of amount, which is pretty extraordinary. And by avoiding central authorities, Bitcoin aims to prevent the kinds of financial abuses and mismanagement that can occur with traditional banking systems, where banks can fail due to mismanagement or corruption and then use tax dollars to get bailed out by the government, right? Which we've seen. And it has a global reach. Bitcoin allows individuals who do not have access to traditional banking services to participate in the global economy via the internet. Bitcoin gives users more control over their money without the need for intermediaries, and it can offer stronger privacy protections compared to traditional financial systems. So now jumping into our favorite part is Bitcoin mining. This is where the money is. The money's in the mining. So we've gone over blockchain, gone a little bit over Bitcoin. So this mining process is how new Bitcoins enter the market. Every 10 minutes, transactions on the Bitcoin network are verified in blocks. So think of the blockchain image that we showed earlier. The miners that successfully verify those transactions, which keeps the blockchain secure and decentralized, are rewarded with newly minted Bitcoin. You know, that's similar to traditional gold miners harvesting new gold. Now, if mining is done correctly, your benefit is being able to acquire Bitcoin for far less than purchasing it at spot price on a market. So miners use their computational power to verify and pack transactions into a block, and each block contains a list of recent transactions and a reference to the previous block, creating that linked chain. And so to add a block to the blockchain, miners have to solve complex mathematical problems known as proof of work. And this problem requires computational resources and serves as a mechanism to secure the network. And the first miner to solve that problem, who finds that algorithm, connects the puzzle piece, gets the right to add the block to the blockchain and gets rewarded. So as soon as one of those miners gets that equation right, think of those algorithms we saw earlier, poof, block is verified, added, and that miner received newly minted Bitcoin as a reward. So the primary financial benefit of Bitcoin mining comes from earning block rewards, which are new Bitcoins given to the miner who successfully adds a block to the blockchain. And besides a block reward, miners also collect transaction fees that are paid by users to have their transactions included in a block. Talking about mining pools, you know, obviously, if you just had one mining machine on its own, and there's a million machines that are all competing, you're basically playing the lottery, you know, if your machine happens to be the one to solve that equation, right? So what miners do is they pool together. So let's say I have 10,000 machines and I join a pool with 90,000 other people's machines. Now we have 100,000 machines all working together to solve the equation. And I have 10% ownership of that pool, or I have 10% of the computing power of that pool. If any of those machines solves the equation, I'm getting 10% of the rewards, which helps keep the revenue consistent. Now, in terms of operating, these mining computers use a ton of energy. They output a ton of electricity. They require a substantial amount of power to run. So miners like NFN8, we negotiate blocks of power through local providers to get optimal pricing. And the energy comes from all types, like natural gas, grid, solar, nuclear, hydro, you name it, just kind of depends on the location. And there's also different types of mining machines. The new generation supercomputers consume less energy while outputting more computational power, which improves mining rewards. So there's really kind of like an equation that you have to get correct when it comes to what type of mining machines, what type of environment are you in, what is your electricity rate, and so many other things, which we've been doing for 8 years now, and feel like we've found the secret sauce, so to speak, for success there. So jumping into IRAs now, I'm going to pivot a little bit, and Colin did a great job touching on this as well. A lot of people just don't know about self-directed IRAs, and that you can use your retirement account for other things other than traditional big broker dealer type investments. So fun fact, under tax code for IRAs, there's not a list of allowable transactions. There's only a list of 5 restricted investments, which are collectibles, life insurance contracts, and there's 6 prohibited transactions, which are all kind of self-dealing transactions in nature. So it doesn't say what you can do, it only says what you cannot do. And that really opens the door for making alternative investments, even outside of cryptocurrency. So a lot of you may know this, but for those who don't, you don't have to just let your 401k or IRA sit on the stock market with a traditional big broker dealer like Fidelity. You can actually obtain literal checkbook control of your IRA, where you control a checking account and can make investments at your will without having to get approval from a third-party custodian or being limited to only use one certain type of exchange. So the conventional IRA is what most people have. This is an account that's held with your broker dealers, such as Fidelity, your TD Ameritrade, your Edward Jones, and so on. With these broker dealers, they sell products, right? And those products are stocks, bonds, mutual funds, right? ETFs, index funds. And that's what you're limited to. If you went to Fidelity and said, hey, I want you to move this money into a machine that mines Bitcoin, they're going to laugh you out the door, right? If it's not a traditional investment that fits their model, they're not going to let you do it. So what we call a truly self-directed IRA is this. You move your old 401k account or IRA account to what's called a self-directed custodian, which is essentially a bank. It has the same regulatory approval as the bank requires. They're compliant with the SEC. They're just a different type of institution that allows you to direct where you want your IRA to go, rather than limiting you to the products that they sell. Now, although they're more flexible, you're still at their whim, right? Like, you have to get their approval. They have to write the check. They may have preferred vendors you're forced to go through for certain investments. If it's a crypto IRA, you have to use their exchange. They might have 5, 10, 15, 20 coins you can select from, which is great, but you're still being limited to their specific exchange, right? So what we specialize in and have specialized in is what we call a truly self-directed IRA, which is when you create an LLC that is specifically designed to be owned by your IRA and managed by you as the IRA participant. It has an extensive operating agreement that lays out what the LLC is being used for. It's referencing legal code. You're not violating prohibited transactions. You're not trying to evade taxes, right? You're just using this LLC to make passive IRA investments. So your money gets moved to a self-directed custodian. You set up a checking account underneath that LLC. That self-directed custodian transfers that IRA money to the LLC. And now you have an entity that's holding your IRA funds where you can literally pick and choose where you want it to go without that third-party approval. So if you want to buy crypto and you want to buy it on Coinbase and Kraken and Gemini, have 3 or 4 different exchanges you're on, or maybe you want to do grid bot trading with crypto, which is very popular, you can do that. If you want to purchase a Bitcoin miner through NFN8 Group to receive passive income, you can do that. If you want to purchase real estate and gold, like when it comes to gold, you don't have to go through the preferred vendor of the custodian. You can choose where you purchase that gold from and where you actually store that. So lots of options there if anyone has questions. It's not for everybody, but anyone that has questions on that, more than happy to assist. So again, I'm Judd. This is my information here. We'll share that here at the end. And now I'm going to go ahead and pass this over to Corey, who's going to give a little bit more of an overview of NFN8 Group very shortly. And then we'll wrap things up and go to QA. You're muted, Corey.
Yeah, I know. Hi, good afternoon. And Sarah, thank you for having us, by the way. We really appreciate it.
Very welcome.
Give your listeners and viewers an opportunity what institutional mining is all about. We are a 8-year-old company based out of Austin, Texas. My partners and I, Josh Moore, Stephen Green, and myself started in a town called Pflugerville, Texas, in a garage with 20 computers and 2 shipping containers. And after months and months of really trying to figure out how to mine Bitcoin in the blockchain, we were successful. And from there, we had to come up with a program how to expand our operation. And we came up with a program which is a supercomputer purchase and buyback program where individuals can eliminate the volatility by owning the same computers we own. And we have a program where individuals can purchase the same computers and we turn around and we'll lease those computers from them. But before we get into that, I would like to show you a little background of what our data centers look like and what computers look like in these specific data centers. So, Judd, if you turn that on, please. Judd, I can't hear it. We're having a little sound difficulty.
Yeah, I guess audio might not be working on it, but you can still see the visual at least.
Okay, no audio.
NFN8 data center facility in Kentucky. Beautiful day in September of 2022. Why don't you guys come on inside and take a look with me and let's see what this place is all about.
I'm here today in Western Kentucky, personally inspecting the facilities of NFN8. These locations they have here are all onshore in the United States and are among the best in the world. They can make repairs while the machines are still on the racks, offer white glove service, and they have 24/7 security.
What you're seeing today is really the evolution of mining. It's called immersion. This will give the machines an extra 3 years of life. Wow, it's amazing.
Spaces like this facility enables NFN8 to actually maximize their investment because being able to mine in a facility like this gives them optimum efficiency to get the returns for their customers, but also be able to maintain the longevity of their assets.
Everything is carbon neutral, so it's safe for the environment. But more importantly, there is an enormous amount of noise, and that is literally the miners generating cryptocurrency 24/7, nonstop.
Excuse the audio. Something that Colin mentioned in his presentation about security. We offer an opportunity which is considered as a security. We are a Reg D 506C. That means anybody that participates with NFN8 Group must be an accredited investor and must have third-party verification that they are truly accredited. The purchaser, the investor, actually owns the asset, which is the computer. We offer a fixed ROI, and we offer fixed monthly payments. But the difference between getting involved in cryptocurrency, purchasing the actual Bitcoin personally, there's a lot of volatility. What NF&8 has done is offered an opportunity to eliminate the volatility by owning a computer, which is an asset, which NF&8 will turn around and lease that asset for between 1 and 5 years. Give you another example. The purchaser owns the equipment 100%. We have a program that when the purchaser buys the equipment at the end of the term of whatever 1 through 5 year lease, we buy back the computer for what they originally paid for. We do offer a fixed income that is paid in US dollars, ACH, from our bank to your bank on a monthly basis, and we directly deposit into your bank as well. And we have 100% repurchase at the end of the term of our program. So to give you another example, you will receive a purchase agreement on a computer that allows us to procure the equipment, and with your name on it, which we give you a bill of sale, and we give you the serial numbers for that particular specified computer. And then we offer a lease agreement detailing from 1 to 5 years and your monthly fixed ROI return. This gives you a little bit of another illustration of our data centers located on the upper left-hand corner of hour and a half south of San Antonio, Texas. This is one of our operations. Another operation on the lower right-hand side is located in Kentucky. We have locations in Iowa. And of course, on the lower left-hand side is my partner, Josh Moore, CEO of NF&8. We've been partners together for the past 8 years. So our program, what we offer is we offer a 1 year at 9%. We offer a 2 year at 12%, a 3 year at 15%, a 4 year at 18%, or a 5 year at 21% annualized paid monthly. And we've been offering this program going on over 90 months of making payments to our clients consistently, from our bank to your bank. So just to give you a recap on typical opportunities out there, from NF&8 at 21%, we know that Treasury bonds today are offering 5%. The S&P 500 is averaging roughly about 500%. And then obviously real estate has been averaging from 8 to 12%. Again, NF&8 offers a fixed rate return. There's no deviation from our fixed monthly payment. It's a contractual for the next 1 through 5 years. Colin brought up something on his presentation, which I think everybody should take a look at if you're looking at NF&8 Group. There's a third-party review site called Trustpilot. This is a great site mostly for corporations. These are clients of ours who have written in about what their experience has been with NF&8 Group. They have the opportunity to freely write whatever they would like to write about us. Anybody who's doing any due diligence, I definitely recommend going to trustpilot.com, type in NF&8 Group, and you will see what our clients have to say about us. These are clients, by the way, who are all accredited individuals, sophisticated investors. They go as far back as 7.5 years. That's how long we have had clients for. And definitely do your due diligence. And we welcome anybody to go over to Trustpilot. Okay. For more information, we have a QR code on the right-hand side that will take you to our webpage. And our webpage is really great. It gives you a breakdown of who we are, what we are, our philosophy statements, our white papers. It'll show you all our data centers. There's a map of all our data centers with videos. There's a great articles page where we constantly update the articles so you don't hear how wonderful Bitcoin is or cryptocurrency is or how great NFN8 is. You will hear what third-party financial institutions are talking about on the cryptocurrency and the Bitcoin itself. There's some great press releases. There's great interviews on mass media about our company. And there's a wealth of information, including bios on all my team members and my partner, Josh, and I. So we would like to, I think there's some time left, Sarah, to answer any questions.
Well, we do have a Q&A session, which would be a great spot to do the Q&A if you guys can come back for that. We have 2 more speakers to fit in before 1 o'clock.
Okay, well, we want to, Josh, pardon me, Judd and I would like to thank you for the opportunity, and thank you everyone for listening in and watching our presentation. Judd?
Yep, thank you all. Looking forward to speaking and answering any questions here during the Q&A. And yes, we will be at Consensus. I saw one of those questions down there. So if anyone's at any of those events, feel free to stop by.
That's awesome. Thank you guys. It's really interesting what you're doing, and I appreciate that you came here and you spoke about it. And I love hearing what different people are doing and how people can get involved in the new stuff, but in, maybe a more stable way. So that was perfect. Appreciate it.
Thank you.
All right, audience, you're hanging in there. We've been at it for 3 hours. We have 1 more hour, 2 speakers coming up. One is going to be story time. I'm going to interview Theo Gogoli. And then after that, we are going to wrap with, Cynthia, would you mind taking down the other video, please? Then we're going to wrap with Carlton Dennis, who's going to talk about different tax strategies you can use when doing alternative investments. There's a lot you can do with real estate, but what about all this other stuff that we're talking about? Carlton, you'll want to make sure to stay on for that. It's going to be really lively. We've heard him speak before, and he's got some great ideas for you because, like I said at the very beginning, we want to know how to act like the wealthy, which is to earn more, grow more, and keep more. So he's going to help us with the keep more part. All right, Theo, if you would turn on your screen and join us. Thank you. How are you doing today?
Good. How are you? Thanks for having me.
Good. Thank you. Okay, so Theo Gogoli, he is my business partner at Sugo Capital, and he has an interesting journey. So we're going to walk through his journey over the last few years, and it's been really fun to pivot with him. And we're going to talk about what he's pivoted into based on all the changes that have been going on in the world, the economy, etc. And then, how we've pivoted at Sugo Capital to open up some of these great opportunities to our community and with our community. So Theo, why don't you start out? You were born in Silicon Valley, and why don't you give people an idea of your foundation, your education, a couple sentences on your professional background.
Yeah, absolutely. So you said, I grew up here in the Bay Area, Silicon Valley. Obviously a lot of tech going around, a lot of startups, a lot of big bets happening, both in the technology side, on the career side. I did my undergrad in computer engineering, so both hardware, electrical engineering, and computer science, and really trying to understand not only how do you program computers, but how do you build them, and really kind of starting from the foundations and really kind of building on top of that. And I think one of the big things that really opened my eyes to is that computers, as much as, computers today are amazing, and we have, language models and generative AI and all sorts of that stuff. But at the base, the computer is it's very simple. It does exactly what you tell it to do. And if you tell it to do the wrong thing, it's going to do, the wrong thing. And so it's a very simplistic and a very programmatic way to design something, right? You design it, you think of an algorithm, you think of something you want it to do, you write it up, and it's going to do what you wrote, right? It's not going to do what you necessarily want, because that might not have been what you actually wrote. And so that was a really kind of big enlightening moment for me early on, which is that computers are their tools, and they can allow you to do all sorts of amazing things, right? From the internet to streaming video to hundreds of people at a time to all sorts of other solutions. But at its base, you have to be very diligent about what you tell it to do, and you have to really think about is what I'm building, is that really what users want? And so that really kind of set the stage for the second half of my career, which is really to move into the product management space around really building products and really thinking about what are users after. And I might have a good idea from a technology perspective, but really how does that fit into a particular user need, right? You might have a solution that it's going to be, oh, I'm going to have an AI that generates a video. But like what need does a user have that fills? And so kind of figuring out like how maybe it's massaging it, maybe it's wording it differently, maybe it's presenting it differently, packaging it with other aspects, other tools. Like maybe then you get to something that fits a problem that users have, and then you really have something you can go to market with.
And I love that, because that is exactly what you did with Steady Eddie, is that you had an idea and a possible product, and then we brought it to the community and we took feedback and we said, what is your problem? What is your pain point right now to the investor community? And based on what they wanted, we built something, you built something, and then we presented it and adjusted it until it was what they wanted. And so I love doing that. And I totally share that same sentiment of create something that fills a need and a gap in what people want. And that's when you're going to have success. So thank you for that. So being in the technology space, building product, something changed or something evolved about 3 or 4 years ago. You took a course with IML, and if anyone here has done anything with IML, I'd love to hear a shout out. I tried to get them to come speak. They are massive right now. They've flown up. But maybe in the future, because we've talked about them before, and people are like, oh my gosh, their courses were so good. And so you learned some strategies. So I want to talk about the strategies that you learned, the results that you experienced, and then what was the emotional side of that? Because what we're going to talk about, you guys, is how to take the emotional roller coaster out of trading. So, you've seen from several speakers today how you can make great returns, and they've all said, note, you can gain 35% in 2 weeks, you can lose 35% in 2 weeks. So you always want the upside, but there is always the downside. And so it does create an emotional roller coaster in a lot of traders. And what Theo has created takes the emotional roller coaster out, much like what NFN8 has done, something that's more steady. So let's back up and talk about the first strategy that you looked at, which was leverage scalping. If you could just say really high level what that is.
Yeah, so about, as you said, about 2-3 years ago, we looked at I started really looking at, trading, online trading, whether it was for gold, for Forex, indices, any sort of different assets. And we started looking at this through a mutual acquaintance that was doing it themselves, having great results, and kind of opened our eyes into this world. And so, took this course with IML in terms of really trying to understand what is technical analysis? Because you look at a market, price goes up, price goes down. Like, why does it go up? Why does it go down? What are the opportunities there? And really kind of diving in deep in terms of the technical analysis of how to look at price action, how to look at the impact of volume on the price, beyond just the fundamentals, right? A lot of investing, especially for stocks, is really anchored on fundamentals. Like, is this a solid company? Is it going somewhere? Does it have plans? Is there legislation that might help or block that company? But when you're looking at, and that's really for really longer term investing, right? If I'm taking the Warren Buffett approach, I'm buying a stock in a company that I really believe in, like whether it's Apple or Coca-Cola, and I think it's going to be a great company, and it's, it has a future in the next 10 years, and I buy it and I hold it. Scalping is very different. Scalping is really looking at very short-term variations in the price. based off of what the price is doing, knowing there are a lot of other people in the market that are effectively doing the same thing you are, that are very actively trading it. And so realizing what is going to cause those other folks in the market to sell at different points and to buy at different points. And that's going to affect the price. And then that presents an opportunity for you to come in and buy when they sell and sell when they buy. So it's a very active form of trading. It can be a very lucrative form of trading, but it's also a very risky form of trading. And I think that's really what, as you said, starts to bring in this very emotional side of trading, because there is so much potential, but there is so much risk. And emotionally, that can be quite stressful. And as you said, it does create a roller coaster of great highs, but then you have this potential of great lows.
Yeah, so Dana had a gold chart up on the screen during his talk, and it roughly went like this, but along the way it was doing this along the way. And so the idea is you can make money in the long run, and then with all the volatility you can also make money in the short run with smaller individual trades that are leveraged, right?
Exactly. And
yeah.
And the thing is, when you take a long-term perspective, you're kind of fixing the amount of profit that you can have from that low to that high. Yeah. But when you look closer and you see all these jagged steps, you can capitalize, and all those, like, it's basically 2 steps up, 1 step down. And when you take those 2 steps up and you keep adding them on top of each other, that's a lot more steps than you would have had if you just started at the bottom and just waited to the top. So there's definitely a lot of opportunities there. And they also present themselves a lot more often. So even if you didn't get in at the bottom, you have the opportunity to ride all these little waves later on as well.
And you mentioned the emotional roller coaster. So can you give us some examples of the kinds of returns that you saw that would give you one direction or the other on that roller coaster?
Yeah, I mean, it's as you said, it's a very highly emotional space, right? You can have, you can make 20% profits in 1 hour, but at the same time, you can get yourself into a hole equally as big, in half that time. And when you look overall in terms of the market of day trading and retail trading, the numbers are actually very sobering, right? I think the numbers are in the range of 70 to 80% of day traders lose money. Just flat out, they're not profitable.
That's a huge number, 70 to 80%.
Crazy number, crazy number. You ask yourself, why do people do this? And the even crazier statistic that they did studies on is traders who are not profitable, right? Who are not making money, they stay in the market and they keep trading.
They're trying to get profitable, but they have a strategy that makes them not profitable, obviously.
Correct. And so I think from a psychological perspective, this was really enlightening to me, because it really highlighted the fact that trading and the opportunity to trade and to make these outsized returns really represents almost a dream to a lot of people. And it represents, an opportunity to change their place in the world, their lot in life, if you will. And for a lot of people, even if they're not profitably making money, they still have that dream, and that dream brings them to still trade. Now, I'm not saying that's a great thing overall, because, I think as some of the people are noticing in chat, like it is somewhat at some point similar to gambling, because you have this draw of this big payout. And so I think, that's really, for me, I looked at that and I was like, that's really interesting. And that's really scary at the same time, right? I know I've seen this emotional roller coaster. I see these figures of, overall what happens to traders. And so I look at that and I go, how can I remove the emotional aspect of this, which potentially could fix, a lot of the problems, because traders are human beings like everybody, and everybody is loss averse, right? You start seeing a loss and you feel that loss, it's a lot more painful than any gain. And so from a trading perspective, you want to be as emotionally neutral as possible, because you want to be very exact and you want to follow a trading plan and you want to do the same things over and over again so that it's predictable. Unfortunately, emotions are the opposite of predictability. And so that's when I really started looking at how can I look to automate the trading, which then takes me out of the equation, me being the emotional being. And how do I take myself out of the equation so that not only do I remove the emotional aspect that I have as being the one kind of on the other side ready to take a trade, but also it provided a second opportunity, which was automated trading happens all the time. And this is really important because when you're a day trader or when you're a retail trader, you know, unless this is your full-time job, which at that point, I hope you are making money because it should be paying you. But if it's not, and if it's something that you're doing on the side, you have a set number of hours that you have allocated to this. It could be in the morning before, you know, you get to your regular job or your kids get up. It could be, you know, in the evening after your work, but you have a set time frame. And what I started noticing is that when you have a set time frame to achieve your goal, you know, whatever the target you set yourself, right? Whether it was a modest goal of, you know, 0.5% profit, you know, in a day, or whether it's a very outlandish goal of 20% in a day. Once you have this fixed time frame that you are trying to achieve this goal in, you are artificially creating pressure on yourself, right? You are no longer able to be patient. And patience is really what you need when you're trading, right? You can't force the market to do anything. If the market wants to go off in one direction, it's going to go off in one direction. It really doesn't care if you just took a trade hoping it was going to, or thinking it was going to go the other way. And so when you don't have the ability to be patient because you have a limited time frame, that really constrains you, and that really starts putting on the pressure, which puts on the emotions, and ultimately leads you to making, at best, less than ideal decisions, at worst, bad decisions. And that's, you know, that's really where everything kind of starts taking a bad turn. And so when I started looking at automated trading solution, that allowed me to basically remove that time constraint, because the algorithm would be running, you know, 24 hours a day, you know, 5 days a week when the markets are open. And if it needs to wait 36 hours for an opportunity to present itself, then it'll do that. If there are, you know, 5 great opportunities in the next hour, it'll capitalize on those as well. It doesn't matter if those opportunities are at 3 in the morning or if they're 3 in the afternoon when, you know, I might have been trading myself. And so that really was kind of a light bulb moment for me around how could I really fix this emotional side of trading, and how can I put a system in place that doesn't have that problem.
Yes, I love it. And I want to pull out a common theme for the audience, that you tried something and it wasn't perfect, but you didn't stop. You kept trying to see, how can I take what I've already learned and my goals and create something that fits it all together? So I want to call out that theme for the audience, that, you know, as you're learning about different things, don't stop. If one thing doesn't work, keep looking, because there's going to be something eventually that fits your goals, your lifestyle, you know, your returns that you need, that sort of thing. So I really appreciate that about you, Theo.
I think that's a great point. And I really want to emphasize is that, you know, when I started off doing manual trading, as you said, it opened up my eyes of, there is this opportunity, like there is this system and there is this way of making profits on your assets and your investments. And then it was a question of like, how do I adjust, and how can I take advantage of this opportunity in a way that fits in my life and in my strengths and weaknesses as well. And, you know, before we did this in the gold and the Forex space, I'd say going back when we looked at real estate, it was the same thing, right? We initially had looked at, individual duplexes and, how can we have those as like our own little assets that we sell out. But, it didn't work for us for a variety of reasons. But we were able to realize there really is something there. We just need to figure out where is the right fit.
Exactly. And I think this is, it also comes from, there are pieces of your personality. You're an extreme athlete. You're extremely focused and dedicated to executing for, basically for long-term gain. Like, how do I do things every day in a very systematic way that gives me the outcome at a later date that I want? And I think that played into how you built the model as well. So I'd like you to dive into, it was about 18 months ago when you started working with the different algorithms, and talk about the results that you had and what you've kind of morphed that into as far as, you know, what you're doing with the hedge funds, and kind of highlight the gold piece of it, because we did have a couple people talk about gold, and I know some of the algorithms are working with gold and how this all works.
Yeah, absolutely. And I think, you know, first and foremost, one of the things that I really loved about algorithmic trading is that fundamentally it's about data, right? Price in the market of an asset that goes up and down is data. The algorithm takes its trades, that generates data that you can analyze and you can understand how it works, and then you can adjust it so that it works in different ways. And I think there was this great quote by Edwards Deming, you know, "In God we trust, all others bring data." And I fully believe in that, you know, that by really focusing on the data and the hard numbers of what is profitable, what is not, why is something not profitable, or if something is profitable, how could we potentially increase that profitability, or how can we limit that risk? And to really take almost a platform or a system approach of, I'm designing this plan, and this plan starts with the amount of capital, and it has a strategy, and that strategy has a certain amount of risk. If I understand by analyzing how that strategy works, I can understand what the risk is on my initial capital. And once I understand that risk, I can start creating a backup plan, right? What if it goes outside of that risk envelope? How do I mitigate that? And so it's more about a planning exercise and an analysis exercise than it is, you know, I'd say actual trading, right? The actual trading is delegated to the algorithm. And then my expertise comes in around, how do I build a system that is manageable, that is configurable, so that I can monitor it, I can control it, and I have plans in place to deal with, you know, how it behaves.
And Dana talked about the volatility of gold and how gold price is going up and the volatility is going up. And he also talked about how gold is inversely related to the dollar in yield. And so I want to touch on that with you and say what you've created. You have multiple algorithms, and some are doing currency pairs. 23 currency pairs are trading, and gold is trading, and it's doing about 1,000 trades per month on each of these, and it's all balanced and nicely packaged. Can you just talk a little bit more about the returns that have been realized, and then kind of the plan going forward?
Yeah, I think gold is a really interesting asset, and it's a really interesting time to be trading gold as well, right? Gold is at all-time highs. And from a, you know, kind of going back to data, from a technical analysis, when you get to all-time high on a price, you're effectively in a whole new world, right? You're in no man's land. There's really nothing that is giving you guidance around where might there be support for that price, where might there be resistance, because there's nothing above you. You're at the top of the ladder, and it's just a question of where does it go. And so it almost becomes maybe a little bit more emotional. And I would say in a way, it's almost similar to what we're seeing with a lot of the crypto assets today, where, you know, Bitcoin got to all-time highs. And when you get to all-time highs, fundamentally, you have a lot of people who have unrealized profits because they bought that asset. It's now at all-time high, and they're sitting on that profit. And it becomes a question of how long do they hold on at that all-time high, and, you know, how often are they going to cash out and realize that profit? And so that's what really starts creating that movement in the price, is when people are cashing in on those profits. For gold, from an algorithmic perspective, I really like it because it is a good counterparty, as you said, to the US dollar, right? The US dollar, which has been, the dominant global currency for, the past 40, 50 years easily, is now starting to lose a decent amount of value, a decent amount of trust in the world. I think earlier there's some talk about, the BRICS side of the world. There's also the realization from a lot of economists, some of them in the US, some of them outside the US, around the size of the US national debt. And what does that mean for the value of the US currency? And so gold historically has always been a source of solid value. And so you're seeing a lot of not only banks, centralized banks from other countries, investing in gold versus investing in US Treasury bonds or in the US dollar in general. And so that's kind of evening out. Now, what that means from an algorithmic perspective and the strategy that we're using in our fund is that by having both of those assets, we can trade both of them. And that's part of why we have so many different currency pairs that we're using, is that some of them may not be trading for several days or even a week at a time, but others will. And that keeps rotating around. Sometimes the Japanese pairs are very active, sometimes the US pairs are active, sometimes the European pairs are active. And when you have a wide enough distribution, that helps to really even out the activity, even out the risk. And we see the same thing between foreign exchange and gold, where when gold is really active, the foreign exchange market tends to be calmer, and vice versa. When the foreign exchange market is very active, gold tends to be a bit calmer.
So the fund, the product that you've created for your clients, it balances these in order to create a more stable solution for them, right?
Correct. And it's kind of like a two-pronged benefit. One is that it balances both of those in terms of an opportunity. So that there's always an opportunity to make profit from either of those asset classes. But at the same time, because capital is allocated to those asset classes within our fund, we can also reallocate funds within there. So if we see that gold is not active and there are no trades being taken against gold, but maybe there is a higher risk price action happening on certain currencies, we can reallocate some of those funds within our hedge fund so that we balance out the risk and we even things out as well.
Yeah, I think it's awesome. I love it. So since we're talking about risk, some of the other people, as the other speakers, as they were speaking, the audience was asking about, what about this? What about that? And they were all questions around risk. And so in the Forex space, and, a lot of people have been hearing about scams and frauds. And so I'd like to touch on, what are the areas that you think are the biggest risk for if you're in this space, and what have you done to mitigate those risks for the Sugo community?
So, like I said, whenever you're doing any kind of investment or any kind of business, you really need to think about what are the different classes of risk, and what are the systemic risks in place, right? I mean, there's always trading risk and risk that somebody gets something wrong, but there's other risks that you might not otherwise think about, right? Like you use a broker to execute your trades, and so there's risk associated with that broker. You might use what's called a virtual private server that is running your algorithm, or that's running your terminal. There is risk associated with that server where it might go down, right? Or if you're trading from your home computer, you might lose power, right? That is a risk, and you have to take that into account. Similarly, especially from a hedge fund perspective, we have a bank account. There is risk associated with the health of that bank, and so it's really thinking of it in terms of being very, I don't want to say pessimistic, but just being very analytical. And at every step of the way, every tool and every participant that is playing a part in allowing you to execute your strategy, what do you do if that tool, or if that thing, or if that person that's selling you a service is no longer there? And if they are not, and how likely is it that they would no longer be there? And that's that is a risk. And so what can you do to mitigate it? And for everything that we do, we try to have multiple providers, right? We started off with a main broker. We're looking at a backup broker because we don't want to have all our eggs in one basket. Same thing when we look at our providers for our trading servers, we want to have servers from 2 different providers, because if one data center goes down, we want to be able to have a second one that we can either move to, or we already have, part of our assets already over there. And we're doing that all the way down, right? Both for our strategies. Do we have backup strategies that we're testing all the time? Absolutely. Because the strategy we have now, we love it. It works great. Do I have 100% confidence that in 5, 7, 8 years, it's still going to work great? No, I don't. But I'm going to be reevaluating every single year. And in the meantime, I'm testing out other strategies so that I have something as a backup in case I need to swap it out. And we do that all the way down, right? Down to our bank accounts. And we started off, we have a bank, we love them, but at the same time, we have to be ready to have a separate bank account because, as part of getting this up and running, we realized, it can take up to 6 weeks to open a bank account for a hedge fund. So if something were to happen to our bank, we should already have a backup. We don't want to wait till that point to then start that 6-week process to have a bank account. So it's really just being very pragmatic, and it's not that we believe any of these partners are going to go down or have a significant amount of risk associated with them. It's just being prudent.
Yeah, and I think that's valid across all investments. So for the audience, next week I'm doing an hour-long on due diligence, and that's one of the things is like, you might talk to Sarah and you believe Sarah, but there are 12 other things involved in Sarah's investment. So you get to figure out what are all the things and do due diligence on all the things, because every step of the way, it's important to make sure that it is safe, reliable, it has a backup, or it has a succession plan. Because one thing is for sure in this investment space, nothing ever goes 100% according to plan. That is guaranteed on every investment I've been in or offered. Nothing ever goes 100% according to plan. So having that backup. So when you're looking at investments, no matter what it is, if it's Steady Eddie, if it's real estate, if it's NFN8, just look at what is the infrastructure and the succession plan or the backup plan for all of these. We've done several things where it wasn't that the strategy didn't work, but a platform involved was fraudulent. So, along the way, something took the money out of the system. So there's so many things we've learned. And so I really encourage you all, as you do due diligence, whether you're going to be active or passive, there's a lot of things that you need to look at and be really thorough and very analytical on. With that, I would love to hear what your next plans are, Theo. So I'll do a quick summary for the audience, for those of you who are new, who are not in the Sugo Capital community before. So about a year ago, had about 700,000 in these algorithms that are working, loved the results. And so we asked the Sugo community, hey, would you like us to build something for you? And like we said at the beginning of the talk, they said, oh, yes, please. So we built it. It's running now. And then there's always the plan to say, hey, community, what else do you want? And Theo, are you ready to build another one if there's something else that people want?
Yes, I think in terms of what we're looking at next, we knew there was a lot of excitement about the fund that we just launched. And so we're looking at having a similar fund offering. From a practical perspective, as I said, I'm looking at other brokers because, even if we could launch 3 of these funds in the next 3 months, do I all want them operating on the same broker? Absolutely not. I want them in different brokers, or I want them equally split across different brokers to spread that risk. So we did a lot of heavy lifting up front to get our first fund up and running. And now I'm starting to look at what are other brokers that we can work with. That's kind of the first layer. I said, I'm starting to look at other strategies, other algorithms that we can use. How can we tweak them? How can we make them different? We're talking with some partners around, they might have different desires in terms of return and maybe different tolerances for risk. And so I'm taking that into account and I'm looking at our algorithmic strategies and saying, okay, if you want to have a tighter risk envelope, how can we make that happen for you? And what are the trade-offs that might be involved? You might have to accept a lower return, or we might be able to present it in a different way by pairing it with different other classes of assets that we invest in as well. So really trying to figure out like what are the different types of parameters that we can tweak to fit the needs of the possible clients that we're working with.
Love it. So with final words to wrap up, I'll say thank you, Theo. I am so in love with the product that we have created, and our community is totally overjoyed that you've created it for them, with them, and I'm looking forward to doing more. And I want to say to the audience, if you love a lot of what you've seen today and you want to be totally hands-off but still get great results, then looking for a hedge fund, looking for a private fund is going to be perfect for you. So we talked in the beginning about, do you want to be an active or passive investor? And so if you raised your hand for passive investor, then this would be a great path for you. So you'll get more information after the fact. And Theo, will you be able to come back to the Q&A to answer any questions?
Yes, I should be able to, yes.
Okay, great. Thank you. We will see you then. Thank you,
Sounds
Theo.
good. Thanks, Sarah.
All right, up next we have Carlton. Carlton, let me enable you to jump on the stage. All right. So I bet some of that was familiar to you because Theo saw you speak at one of the tax events that one of our friends was holding. So this is great. Carlton, I gave him a lowdown of what this audience is: sophisticated, intelligent, hands-on investors, traders, but also some passive investments, but like a lot of different things.
Yeah.
And so I asked Carlton, hey, if you're in real estate, there's kind of a clear path to the tax benefits, but
Yes.
what are some ways that all of these folks are making, these great returns? How can they keep more of them? So I'm excited to hear what you have to say, Carlton.
Absolutely. First off, thank you so much, Sarah, for having me on. This is an incredible event. And Theo, you absolutely dropped some bombs there. And I don't know if anybody else felt it. Like I wanted to put some money into the market and into some trading softwares after he got done speaking. So kudos to you, Theo. I won't bore you guys today. I know I'm the tax guy coming up, and taxes can be a little bit boring and unsexy. So I promise to make this as interesting as possible. But I just want to talk about some of the tax implications and strategies for alternative investments, because we all know that real estate is, one of the most powerful tools to building generational wealth. Andrew Carnegie said 90% of all millionaires did so through real estate investing. And I know many of you guys that are out there that are probably sitting on big portfolios have done so through being active in real estate investing. But as you guys know, and as many of the other speakers have told you, it's important for us to diversify our investments right now, especially when there's, uncertain conditions that we're faced with, interest rates, all these types of things. So it's just nice to be able to diversify our investments and still get a nice, generous return. And I am invested into hedge funds and crypto hedge funds, as well as trading software. So I'll be able to share with you guys some of my insights about that. But as you guys already heard from all the other speakers, alternative investments are anything other than stocks, bonds, or cash. And I'm personally a big fan of alternative investments. I've been spending a lot of time studying gold, putting more of my resources towards gold and silver. And I'll talk with you guys a little bit more about that. Commodities trading, oil, gas, wheat, corn, coffee, as many of you guys know. And of course, the big elephant in the room, Bitcoin and other cryptocurrencies. We're headed into a bull run, as many people are saying. And so hopefully a lot of you guys out there are properly allocated. Now, investors need to know the key tax implications and strategies for alternative investments. So I'm going to quickly go over some of the strategies I utilize with some of my clients who are day trading in the market, going into crypto, going into gold, and how they can mitigate some of the tax bill. But before I jump into that, for some of you guys that aren't familiar with who I am, I'm a tax strategist. I'm a licensed enrolled agent in all 50 states. I hold the highest designation the IRS gives out to accountants, but I'm not a CPA. I have an amazing CPA team of 30 individuals that work underneath me, but I don't file tax returns. I work with entrepreneurs, real estate investors, and I figure out ways to reduce their tax bill. We started a YouTube channel that's well over 700,000 subscribers. I'm a Forbes member, and I'm official tax partner with the Bigger Pockets podcast team. So I really like talking tax strategy. I never saw my career being behind a computer, just inputting stuff into a tax software. but I like connecting with individuals who are doing really creative businesses or have creative investments or funds and figure out ways to leverage complex entity structures to reduce overall tax. So as you guys know, us as investors, we prefer the capital gains tax rates to the ordinary income tax rates. But as you guys know, there's short-term and long-term capital gains rates. So I'm quickly going to show you some of the changes here. This is the new short-term capital gains rates tax brackets. These got updated right at the end of last year, November 12th, 2023. The IRS released their inflation adjusted tax brackets. And if you just quickly glaze over married filing joint 37%, we are now at $731,200 to hit the 37% tax bracket as a married individual and $609,000 as a single filer. That has gone up significantly. So when people say, oh, I'm in the highest of tax brackets, yes, you might be, but let's look at where those tax brackets have gone because the IRS has done an incredible job of inflating the different brackets. That's the one thing they have done well for us. Okay, so here are the long-term capital gains rates in case you were wondering. If you are planning on selling, any stocks, bonds that you guys might have over a 365-day period, you will experience the favorable tax rates of 0, 15, and 20%. This is where we like to live as investors. We want to stay in the lower tax rates, right? If we're single, we want to try to keep our tax rates beneath that 20%. But if we do make up capital gains over $500,000, that's when we finally jump into that 20% rate. Sometimes when I'm talking to investors, they tell me, Carlton, I'm paying the highest percentage of tax rates. Well, yeah, but it's only the amount of money over $518,900 that's actually subject to that 20% long-term capital gains tax rate. The majority of people who experience capital gains are typically paying between 0 and 15%. So just keep that in mind when you're factoring in your taxes for this year or you're doing tax planning with your CPA or advisor this year. Now, let's get into some of the fun stuff. And part of the reason why I'm here today is how do we reduce taxes for alternative investments? What are some strategies? What are some techniques? What are some of the things that the wealthy class talk about that most other people don't have access to unless they're upgrading their professionals? Well, one of them being that you already know is real estate investing. And if no one has covered it here, I like utilizing real estate losses on the tax return. We have a method in our office that we coined the RAD method. And it's very similar to what many of you guys are doing. We typically will teach a taxpayer to start off running their own real estate business by forming their own LLC, or maybe they have a general partner status in a syndication or a fund. But then we want to reach for real estate professional status, right? The IRS has specific designations around who a real estate professional is, someone that spends 750 hours and half their time in real estate more than any other thing. But for many taxpayers who are still working in a W-2 job or self-employed, and they're spending a lot of time in their self-employed job, it's hard to qualify as a real estate professional. So this is why the short-term rental rule has become extremely popular. If some of you guys are on social media, YouTube, you'll hear a lot of taxpayers talking about the short-term rental rule. I know Bigger Pockets did a whole segment on this. And the reason why it's so popular right now is because Airbnb became so popular right around 2020 with COVID and us not being able to go travel everywhere. So people were starting more Airbnb businesses. Well, that also gave people more time to look at the tax code around Airbnbs. And in 1987, the IRS changed tax laws as it pertained to short-term rentals. If you're running a short-term rental business where your tenants are staying in the property 7 days or less per customer, and you manage that property for 100 hours in the year, which is called material participation in the real estate world, you can activate real estate losses on the tax return as active losses instead of passive losses. So I have tons of W-2 taxpayers or 1099 taxpayers that are self-employed with their S corporations leverage the short-term rental rule because they don't want to spend so much time trying to qualify as real estate professionals. So we always have that in our back pocket, which leads us to step number 3 in the RAD method, which is accelerate depreciation. I have probably done already in 2024 well over 380 cost segregation studies already this year. Now I'll cross 1,000. It is a big component to our business. A lot of the clients that work with us are looking for the best prices on cost segs, but the cost segs that are going to give them the best benefit on the tax returns. And so if you're somebody that's wondering how do real estate investors really get all this upfront tax write-off, it's because they're accelerating their depreciation instead of waiting for it. And I can contest and say that, it's looking like tax rates might go up, guys. So if I'm trying to save the most amount of money I possibly can now, knowing that tax rates are going to go up, probably would be in my best interest to look at accelerating depreciation and also having the correct exit strategy when it comes to real estate so I can defer capital gains with a proper 1031 exchange. Okay. So next strategy I want to cover is one that I started utilizing last year, which is the private family foundation. Put in the chat box if you have heard of this concept before. Maybe you've seen athletes, entertainers, movie stars talk about their foundations, The Rock, Oprah. I'm donating to the Maui Foundation. Go ahead and let me know in the chat box. The private family foundation is a wealth building tool, and the wealth class have been utilizing this for quite some time, but everyone has access to be able to use a foundation, especially if you understand the rules. So let me teach you. With a private family foundation, you can deduct up to 30% of your adjusted gross income on a yearly basis. That is a substantial amount of money, especially if I'm trading in the market or I took money out of the market, I'm experiencing capital gains and I do not want to pay those capital gains taxes. I can roll over 30% of my adjusted gross income into my own private family foundation that I'm in control of. That bank account could be at Chase, Bank of America, a bank that I trust, and I can control how I wish to be philanthropic. The words private family foundation mean exactly what you probably think. It's private, it's for your family, and it's meant to be for a foundation philanthropy purposes. Many people who set up these private family foundations choose to allocate their family members to be on the board of directors, which allows for you to be able to compensate family members in the event that they are doing charitable activities on behalf of that foundation. It also means that you can also throw your fundraisers, events, and donate other things like commodities, gold, to your foundation for a tax deduction. Did you know that there is no capital gains tax inside of a foundation? So if you happen to trade inside of your foundation, which yes, I do have clients that have trading accounts inside of their foundation, it is 100% allowed. You're more than welcome to do so. There's no capital gains tax. There's only a 0.5% excise tax that is inside of the foundation on any cap gain income. This is considered an income shifting strategy. Why? Because when you shift money over into a foundation, the money that's there, all of it doesn't have to go out to another 501c3 or philanthropy purposes in the year. Only 5% of the remaining charitable assets actually have to be donated out on a yearly basis to another 501c3. So let's just say that Carlton's adjusted gross income is $1 million and I roll over $300,000 to that private family foundation. Well, 5% of that $300,000, what, 15 grand? I only have to send that out that year in order to really remain in my 501c3 status. The remaining amount is left in the foundation and can be invested and can grow as the foundation grows. So I love that strategy. It's a tax advantage growth strategy as there's no capital gains taxes inside of the foundation. It's a powerful wealth building tool. I have tons of high net worth individuals that utilize this in combination with the cost segregation studies strategy. And also being able to incorporate their children and kiddos into some philanthropy activities. Okay. Now, the next strategy I want to talk about is investing in oil and gas. And oh my gosh, it just looks so boring. But you know what? Boring businesses and boring investments work. And we have to be okay with that. I'll be honest, I never really would want to go out there and actually check on one of those gas wells because I really wouldn't know what to do. They go down, they go up. That's all I know, right? But there are so many incredible tax benefits to investing in oil and gas, and taxpayers can deduct 100% of both tangible and intangible drilling costs. Tangible drilling costs is what goes into actually building the drill. Intangible drilling costs are all the ancillary items that go into running that operation, which could include payroll and paying for the members who are running that drill. You're able to deduct the expense of investing into oil and gas. And when you invest into oil and gas, normally in the first few years, because you're making a large investment, the investment is performing at a loss in the first few years. That loss is considered an active loss on the tax returns that can offset W-2, K-1 income, and capital gain income as well. So as long as you're investing in what's called a working interest, it's considered active income that flows through on your tax return. And small producers who invest in oil and gas get a depletion allowance that excludes 15% of all the income from tax that they make off their oil and gas wells. This actually really became interesting to me because I normally deal with a lot of clients that are like self-employed or real estate investors or fund managers, syndication owners. But I started getting a lot of clients that just solely invest in oil and gas all of a sudden. And next thing you know, I had clients that only lived off of oil and gas cash flow. It was crazy. I never seen this before. And that's what sparked my interest. And I learned that the tax benefits almost mimic the real estate benefits as it pertains to depreciation and active losses on the returns. Now, this next strategy is one that is not talked about very often, and it's because there's only a handful of specialized attorneys that really know how to leverage these strategies very well. And charitable remainder trust are truly a strategy that is for taxpayers who are experiencing capital gains. And this can come from a number of different sources. Maybe you're getting ready to sell your business and you're going to have a big gain, or maybe you're trying to take a big amount of money out of the market, whether it's in the form of crypto, stocks, you name it. Sure, you can loan against your portfolio, which would be advantageous to you. And I would highly recommend that you loan against your stock portfolio. It's a great wealth building tool, but sometimes you just need access to those funds, or maybe you want to sell something and get out of a position. Well, if you want to be able to avoid taxes while getting out of a position, you can look into what's called a charitable remainder trust. And a charitable remainder trust is an irrevocable trust that you are establishing for philanthropy purposes. The IRS will allow for you to roll over 60% of your adjusted gross income into a CRT. That's the acronym. And the benefit really to the CRT compared to the foundation, as I'm sure you're probably already wondering, is with a CRT, there is no 5% rule that has to be donated out every single year. So if you decide one year you want to be philanthropic with your charitable remainder trust and another year you don't, it's not going to really impact you. But the benefit of the CRT is that the CRT can purchase an annuity policy. And that's what turns this vehicle into what's called a CRAT, a CRAT, a charitable remainder annuity trust. Maybe you took $1 million out of the market, but you don't want to pay taxes on the $1 million because you know that $400,000 is going to go to Uncle Sam. So you roll that $1 million into a CRT, and your CRT purchases an annuity policy that pays you about 8 to 9% of that $1 million. So now you're getting only about $80,000 to $90,000 that actually flows over to you as taxable income, whereas the remaining amount stays in the charitable remainder trust for charitable purposes. Now, Carlton, it says charitable remainder trust. Could I have the remaining amount if something were to happen to me, God forbid, could I leave the remaining amount of charity going to my private family foundation if I had a separate foundation? And the answer is yes. When you pass away, God forbid, the remaining amount that's left in your trust is meant to be philanthropic. But if you have a private family foundation, which is underneath the 501c designation laws, the remaining amounts that's sitting in your charitable remainder trust, which by the way is invested, that money is sitting in conservative investments, bonds, mutual funds, you name it. The remaining amount is going to flow down into your private family foundation, which of your children should be the beneficiaries of your private family foundation, or should at least be on the board of directors. Now, another benefit to the CRT strategy, and I'm just going in on this one right now, guys, so just bear with me. Another benefit to the CRT strategy is if some of you guys have learned about life insurance and the benefits of the cash value side, which I'm not going to bore you with, your charitable remainder trust can purchase a cash value life insurance policy that you, the individual, could be a beneficiary of while you're living, which means the cash reserves you can borrow against with the same money that you got a tax deduction for that went into the CRT. So I would love to spend more time breaking that one down, and maybe I will be able to when we go to the panel and we do some Q&A. But I absolutely love the CRT strategy. Last year, I utilized this with 7 clients who were selling their practices and businesses, and we were able to roll over a considerable amount of money into these CRTs. We purchased annuity policies. They're getting paid out at a smaller amount. And we have a benefit for them after their succession if something were to happen to them. These are just some of the many strategies that you can leverage when you're dealing in alternative investments like crypto, commodities, gold, and you're experiencing capital gains. Now, one last thing that I want to cover, which really isn't on this slide today, before I go into tax planning, is the mark-to-market election. The IRS has created this election status for day traders that is called the mark-to-market election. And if you qualify to be a day trader, you can make this election by March 15th of the year, which we are already past the election date. And it allows for you to experience 100% of your capital losses in the market in the year, but it also treats 100% of the income that you experienced in the market as ordinary gains. So instead of being limited to only $3,000 in losses that you get to receive to offset other forms of income on your tax returns, you get to utilize all of your losses that you experienced in the market by making the mark to market election on your tax returns. This election is underneath the IRS designation of 457F. If you're a nerd like me, you just type that in on Google and you can read more about it. But I just wanted to make sure I cover that. Now, before we head over to Q&A, I would be remiss if I didn't tell you guys what tax planning is and why I spend a majority of my time doing tax planning. It's pretty awesome. There are 6 real steps to strategic tax planning, and I'll outline them for you guys right now. The first step is getting organized. A lot of taxpayers who, are trying to save money in taxes are typically just working with a CPA. They don't have a tax strategist yet. And if you're trying to do tax strategy and your books are back in 2023 and you're on extension and you haven't started reconciling your books for 2024 and we're already in the month of May, a tax professional like myself is not really going to be able to help you because we're not in real time. I can't determine how I can best strategize for you if I don't know where your income is at today and how much you've expensed as of today. So step number 1 when we're doing strategic tax planning is we have to get the client organized or make sure the client we're working with is caught up to today's date. The second thing is before jumping into the current situation and restructuring entities and setting up charitable remainder trusts or foundations, is that a great tax professional will just take a look at the prior tax returns because the IRS gives you 3 years to go backwards. So if you missed out on strategies in your 2023 returns or your 2022 or 2021, if you go back in those years and see that there's money that you can get from making adjustments to the return, you can file a 1040X, and that's an amendment to your tax returns. Refile those returns and claim refunds on amounts that thus should have been paid to you for whatever it may be. Negligence, just we didn't know that we could do these types of strategies, and that's where we always like to start. Let's look under the hood before we start making recommendations. But once we get past the past, now we're in your current situation. Today is May 16th. We are already 5.5 months into the year, which means we've already experienced 5.5 months of taxation. So we need to know where we currently stand as of today. This also comes down to what your goals and your visions are. Are you trying to move from one state to a different state to maybe escape state taxes? Are you thinking about getting married or, God forbid, a divorce or possibly even having children or family members that are getting older? Are you thinking about a buy-sell agreement? Are you thinking about a merger? Are you thinking about starting another fund, raising capital? Are you thinking about getting out of something? So understanding what your vision is can also help a tax professional or strategist leverage the tax code for you versus just looking at your books and P&L and saying, let's just put money into a retirement account. I think most taxpayers that are on this call today are looking for more creative strategies than putting money into a 401k account. So if that is you, then we have to make sure that the tax professional that you're working with truly understands your vision so they're leveraging the full tax code, not just the first 100 pages. Now, once they get a good, clear idea of your vision, because your vision is going to be different than other people like you, even though you may be a real estate investor or a consultant, and sure, there's tons of real estate investors or other consultants out there, your family situation, what you have going on is different than your neighbors. And that means everybody should really have their own customized tax plan so they can implement their own strategies individually. And that is why I love strategic tax planning. We get to do this conversation every single year. You're making financial decisions. You're working with a tax professional in real time. And this tax professional is the one who actually consults with your CPA. So that way your CPA just does their job, file the return, input the data into the software, and you can ride off into the sunset with your tax strategist again, making financial decisions and leveraging the tax code to the fullest extent. Guys, thank you so much for having me on. And I wanted to make sure that I had a chance to cover any questions as it pertains to alternative investment strategies, as it relates to tax, and as it relates to real estate investing. Joseph said, right off into the sunset. I love it. Okay, I'm pulling open Q&A, but I'm not sure if there's any in there. It says, Carlton, when a CRT buys a cash value life insurance policy, where you are the beneficiary, how does CRT provide you that money? Is it via a collateralized loan, non-taxed, or a distribution? Yes, that's correct. Yes, you would essentially take a loan from the policy. That's 100% correct. And you would donate to the CRT either cash stock to the CRT. The CRT then purchases the life insurance policy and can name its beneficiaries, which you being one of the living beneficiaries as well. That's a great question. How can a charitable remainder trust be leveraged to avoid capital gains taxes on rental real estate? Oh, great question. So if you decide to sell an investment property, you could choose to roll the capital gains into a charitable remainder trust for a tax deduction. And that's how the CRT can help benefit you. But at the same time, if you wanted to open up liquidity from the CRT to be able to use some of those funds, then you would need to have that CRT purchase an annuity. And there's two different ways in which CRTs do this. They're either the charitable remainder annuity trust or the charitable remainder unity trust. So if you guys type in CRAT versus CRUT on Google, it'll pull this diagram up that shows you the differences between the CRAT and the CRUT. But essentially with a CRAT, a charitable remainder annuity trust, you're getting a dollar amount every single year that comes over from your CRT. So whether your CRT grows or decreases in profit due to the market that year, you're still going to pull the same amount of money out of that CRT every single year. Whereas with a charitable remainder unity trust, you're pulling out based off of a set percentage, like 8 or 9%. And I typically like the charitable remainder unity trust a little bit more, because if you experience upside in your CRT's account, then that means that you're pulling more money out of that CRT in any given year, as long as your investments continue to grow. This is a great question that came on from Denai Powell. What is a reasonable range for investing in a tax strategist? You know, that can be a wide range. It can range from $0 all the way up to millions, right? It all comes down to what the tax professional can provide for you. A real savvy tax strategist is going to get on the phone with you and figure out how much you're overpaying and then charge you probably a percentage of what they can save you. If they can save you $100,000, paying them $20,000 probably makes sense, right? That's an $80,000 spread. Does a private family foundation require staffing, full-time, part-time volunteers? Absolutely not. Your private family foundation could just be you, but it does require 4 other board of directors. So this does need to be people that you trust, but it doesn't have to be family members. But a majority of the foundations that we establish are with family members in mind. And the reason why is because let's just say that you want to go and have a board of directors meeting in Florida, but you're running your business out of California and you want to bring your family members with you to have a board of directors meeting for your foundation. Because your family members are on that board of directors group, the foundation can choose to buy those flights, those Ubers, and those hotels, and your family and you are all traveling to Florida on the foundation's dime in order to have that board of directors meeting. That would behoove you, right? As opposed to just maybe you and your wife, and now some of your family members that you would want to come with you can't write that off, and it doesn't benefit you from a tax perspective, right? So just something to take into consideration. Now, you can also employ children as well as family members through the private family foundation, but keep in mind, as you do so, that is taxable income that comes over to them. So we just want to be mindful of that.
Might be a great time to go ahead and say all the other speakers who are in the green room. If you want to re-enter the stage, we can open up the Q&A for all topics. So audience, if you want to chat in the chat, very cool. But if you use the Q&A, the question and answer function on Zoom, it's much easier for us to track what we've already answered. So use the Q&A, and then speakers, if you want to look in the Q&A and just find something that you think is interesting, pertinent, that you would love to answer, just pull it and start answering. It's a free-for-all.
All right, I see some of mine at the top, so I'll take 2 of those, which are referring to the fund that we've offered right now. We unfortunately were not able to offer it for accredited investors, which was what we wanted to do initially. And so the question is, will we have a similar offering for either for accredited investors, but not qualified eligible persons, which is the requirement we had, or are we going to have an offering for non-accredited investors? So I can't say about any plans we have right now concrete, but what I can say is we are looking into all the different options in terms of the way we can structure the funds and what the requirements are for the investors that participate in those different vehicles. And we're weighing out the amount of folks that would want to participate that meet a certain threshold versus what might be regulatory or filing differences by employing a different kind of vehicle. So we are exploring those spaces. We know there's a lot of folks that we wanted to bring in to the first Steady Eddie fund that we were not able to bring in. We absolutely apologize, and we absolutely wanted to make that happen. But from a regulatory and a compliance perspective, the hurdles were definitely not what we expected. So we are investigating that space, figuring out how we can make that happen.
Thank you, Theo. Let's see. I saw some people asking for clarification. This is for NFN8. So your offering is a fund, and someone's asking what's the minimum investment?
Actually, we're not offering a fund. We're offering a sale leaseback where the purchaser or the investor purchases the same computers that we do, and we turn around and lease that computer from them from a 1 through a 5 year, and the minimum participation is $30,000.
Thank you, Corey. Matt, this is from David. He said, hey, there's something about some AI stuff and PDF access to some AI stuff. Is there a link? David, we will send it out, but Matt, if you also want to drop it in the chat for...
Yeah, there's a free PDF guide on the AI presentation. You can catch the watch list there as well. Put it in chat just barely. And I did get another question in the Q&A, or he answered in the Q&A, but I'll just answer it here. Question regarding, do you have to start investing with 100 shares of some stock, whatever the stock? The answer is obviously no. You can drip method in, you can start with 1 share, you can start with 2 shares. We don't really get concerned about commission cost in the stock market any longer, since they're pretty much gone. They're of the past to a certain extent. So you can certainly drip method. The 100 shares goes to the concept of writing covered calls in the stock market, which you definitely want to get to. But oftentimes you build into that position and you don't start with that position. So you can start with 1 share, you start with 100 shares, but the 100 shares does go to the conversation regarding covered calls.
Thank you, Matt. Guy, this one's for you. Can your indicator be used in other platforms? And is this platform available in the US?
Yes, our platform is available in the US. If you go in, you can, in fact, most of our members are in the US anyway, and it's not available on other platforms.
Excellent.
It's unique to us.
Okay. James, I like your questions. One for a laugh. Where can I buy lunch with Bitcoin? I don't know it today.
Probably El Salvador.
Yeah.
Good.
This might be for you, Dana. This is from James. If we would like to buy gold locally to take actual possession without leaving a financial trail, how can we do that and be sure the gold we take possession of is the real product, an ounce of gold is pure, or that it's pure?
Right. So I recommend the sovereign minted coins made by the US Mint, the Canadian Mint, the Austrian Mint. There's a couple others too, British Royal Mint. They all have anti-counterfeiting design features added to them to make it harder for the Chinese to knock them off, which is a small but growing problem. So deal with a reputable dealer. Find someone who's preferably in the Professional Numismatist Guild, which is the leading organization of rare coin dealers. We've been around the longest. You can pay with cash up to $10,000 on a single transaction without a dealer like me or another reputable dealer having to fill out a Form 8300 which is a cash reporting transaction. You can spend $1 million with a check and it's not reported, but they want to track hard greenback money. So you can go into a store with less than $10,000 in cash and just buy over the counter. If you have someone locally that you want to go see and you're not sure about them and you want to email me, you can email me at Dana, D-A-N-A, @amergold.com, and I'll help you individually that way.
Awesome, thank you. This is for Carlton. A question around if someone already has a tax strategist and they want someone to just look at that strategy as like a second pair of eyes, a second opinion, is that something that you do?
Yeah, absolutely. You guys can go to taxalchemy.com and my team would schedule a review call with you to just see what's missing. Are there any strategies you're not currently leveraging? And here's how much we think you could be overpaying. And what do you want to do about it? Do we want to solve it now? Do we want to solve it later? You'll get that option.
Cool. And while we're on you, I have another one. Would the IRS yell at you for deferring capital gain taxes in CRT?
Oh, no, absolutely not. No, this is underneath an IRC regulation. The CRT is a strategy that is for philanthropy purposes. Yes, you're minimizing your tax obligation, but at the end of the day, you do have to be philanthropic with those assets that are remaining in the charitable remainder trust. So it's not scrutinized by the IRS.
Awesome. Okay, this is from Charles. Any of the speakers, can you facilitate? I'm not sure if I understand this question actually, now that I started reading it. Can any of the speakers facilitate buy house in Florida via Bitcoin? Oh, facilitate maybe buying a house in Florida via Bitcoin or Ethereum? Is it possible to buy homes with crypto?
I think you could buy it directly. Go ahead, Judd. Go ahead.
No, I was gonna say, I know there's real estate agents like here in Austin who offer programs where you can send Bitcoin and then they convert it to cash. But it's like, you might as well just convert your Bitcoin to cash anyway. It takes 10 minutes. But you can, yeah. You just have to
you can buy a car with Bitcoin, buy Lamborghinis with Bitcoin. I don't know. I mean, it's now being widely accepted all over. So,
yeah.
I didn't know you could buy a Lamborghini with Bitcoin.
You can.
Oh yeah.
You can buy it through the dealership, by the way, not Larry's Lamborghini, but through the dealership.
Hey, if Larry accepts it, we're all good.
Oh, that's a complete different other story.
It's a handshake agreement there.
We're talking about legitimacy and transparency. I mean, it's widely being accepted all over now. I mean, there's coin ops that you can buy Bitcoin through machines right now, all through the country. Anyhow.
Yeah, I think it's a similar question to like, can you buy a house with gold, right? If the entity you're purchasing it through will accept the gold and they'll set a dollar amount of what that gold is worth, they might, but usually you would just, sell that gold for cash, just as you would Bitcoin, looking if you view it as a commodity, not so much an actual form of currency.
Good answer.
Cool. I just learned something. I don't know if we can pay with the Lamborghini service with Bitcoin.
Soon.
I wonder if the service department takes Bitcoin. That'd be cool.
Right.
All right, Dana, this one's for you. Someone was hustled. I assume it means they were sold something they didn't think they were buying. How do we fix the problem? Do you have any solutions?
Well, it just depends on who did what. I can try and help again individually. Email Dana, D-A-N-A, @amergold.com. I have been an expert witness for the government on two CFTC/SEC cases where dealers who were an unregulated business have oversold by quite a lot to individual investors. So I know how it works. And as a past president of the P&G, I know how to press the buttons if you've had a problem. So I'll help you any way I can because I don't want to see that happen.
It's a very nice offer. Carlton question, are there any tax strategies for revocable family trust?
So setting up a revocable living trust is pretty much setting up like a basket, right? You're essentially just having a basket to transfer assets over to your beneficiaries if something were to happen to you. And you can stuff that basket with many rental properties and IRAs as you want to. But there's no tax benefits to having a revocable living trust other than step up in basis, right? So if I bought a property for $100,000 and God forbid something happens to me and in 15 years my daughter inherits that property and it's worth $1 million, there's a $900,000 gain that she would thus have to pay capital gains taxes on if I did not have a revocable living trust that property was sitting in upon the date of my death. But if I did have a revocable living trust in place and that revocable living trust owned my assets appropriately, then my children would receive what's called that step up in basis, which means that they could turn around and sell that property at $1 million with no capital gains taxes because their basis has been lifted up from that 100K up to 1 million.
Got it. I'll just do another one for you, Carlton. The mark-to-market accounting as a trader, if you meet the criteria for a number of trades per year, holding period and other criteria, but also have a full-time job, how do you qualify?
You could still qualify. It's an election. It's literally a box that we check on the tax return. If you meet the qualifications, it's completely fine for us to make that election for you. We can also send in a letter to the IRS making the qualification ahead of time. So that's something that we do for taxpayers right at the end of the year for the following year, just so we don't forget. If we know that they're going to be going into trading in that following year and they want to be able to experience 100% of their losses, we'll send in a letter to the IRS declaring the mark-to-market election for the following year.
And that's really only useful if you have losses. There's no other advantage if you only have gains.
No other advantage if you have gains, because if you just have gains, then you're taxed at ordinary income tax rate. So you're paying up to 37%. Whereas, if you choose to not do the mark-to-market election, then you might have the more favorable capital gains rates, but you're limited on how many losses that you get to experience against other forms of income. So pluses and minuses.
Mm-hmm. Trying to see how Theo doesn't have to pay tax. All right, this one's from Jeff. I had been a BlockFi customer and waiting for the payout email. I'm scanning it now and seeing if I want to read this one. Maybe I'll kind of summarize it because I saw some other things that were similar. Because in this space, and maybe everyone can answer how this might be taken care of in their own industry and in your own space. So it's someone talking about something that didn't work out the way they wanted, a scam, fraud. And so we heard someone say that about gold, heard people say, crypto, other things, Forex. So maybe we do a roundtable on this question and give a piece of advice on in your space, how someone can avoid a scam or a fraudulent situation. And if they have experienced it, what can they do retrospectively? I'd like to start.
I can start off. From a trading and especially automated trading perspective, the key things you have to be careful of is obviously, do you own your own trading accounts, right? Or are you participating in what's called a PAM trading scheme where you're getting mirrored trades from somebody else? A lot of times when you do that, you might not actually be in control of the account itself. So do you own the account in terms of the login and the password? Do you have control over the server on which that trading account is running? Those are two big things that for us were a really big learning, where there are a lot of simpler solutions and simpler offerings that you might come across. But if you don't have control over your trading account, if you don't have control over your trading terminal, fundamentally that's an opportunity for something to go wrong. And I think there's a lot of parallels there to the crypto world where, I think the saying is, not your keys, not your coin. I think there's, a lot of parallels there where there are services that make it easier, right? Like whether it's a Coinbase or a Gemini or, what was an FTX, to get crypto, but, you are giving something up for that convenience.
Yeah. And to piggyback off Theo, I can relate to you, Jeff. When I started working in my mom's office, I got an email. I was 19. I got an email from some random person telling me to go. It was someone posing as my mother telling me to go to Target and to get gift cards from Target and liquidate those gift cards. It was a whole situation. And I was very, 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 very close to doing exactly what that email was telling me to do. Sometimes you just put your trust into certain emails that you see. But now, anytime I get an email, I'm always assuming, unless it's someone who I directly know, I'm always assuming, what is this person trying to get from me or take from me? Let me be a little bit more cautious and look at the bottom of the email to see sometimes if this is a correct email address. And sometimes when I'm looking at email address, I see all these weird numbers, XYZ, XXX at Gmail, XXY. So I just know that they're phishing, scammy emails. So, there's probably a ton of different techniques that you can install to try to avoid having scams happen to you. But those are just some of the tips that I have, is just to be very careful inside of your email.
I would also say if it's too good to be true, it usually is scenario. I think that the two scenarios that most scammers use is unbelievable returns, and then speed. One of the things that we've always done is, in my investment career, is just really tell people that if anyone's rushing you into a decision, they're not going to be around long enough. And it happens all the time, unfortunately. So it's really important to do that, to just take a step back and not make any financial decisions quickly, even if it's, sometimes people, I've seen the scams where it's like, oh, it was only $300, only $500, but it's only $1,000. But ultimately, like, every dollar counts. And so I would just say, for everyone that's had a situation like that, to just take their time. Anyone that's in the business of whatever we're doing, what all of our businesses are, everyone, if they're going to be in it for a long time, they're not going to rush you to make a financial decision, because they want you to make an informed decision. And so if you feel that you're rushed, then you should take a step back. And it's always a scenario that the returns are so much higher than what the norm is in that industry. There's certain norms in every industry of returns. And so if they're far exceeding those, and telling you to move quickly, it's typically a scam, unfortunately.
Yeah, I would.
Let me jump in very quickly on this one, on the scammer type comments, because technology is getting advanced out there, and they're getting very creative on the scamming side of the equation. And 4 hours ago, we talked a little bit about AI, and that's going to be one of the concerns as we do move into the future, is how AI does speed up that concern on the scamming part of the equation. We run a Discord service at Tackle Trading in our community, and scammers are out there, and they're basically coding everything that looks identically to you. And then they will privately message people in your community acting as they are you. And so what I would suggest on this, and I think everybody would agree, do your homework. Do your homework. I heard somebody say, don't make a quick decision, do your homework. Make sure that it is truly for you, and go third party. If for example, Trustpilot is a wonderful survey service that is secondary, that you don't really have control over. I know I saw Corey and Judd pull up their Trustpilot ranking. I'm pretty proud of ours at Tackle Trading as well, because that's how you can kind of make sure that you stand out against some of the fray out there and some of the craziness and some of the nonsense. But at the end of the day, you just got to do your homework out there and make sure that you're dealing with legit organizations, legit investors. And the simple reality is, Sarah's done a wonderful job of bringing together amazing speakers here. I was the first speaker to go, but I sat like a fly on the wall the rest of the time, and every single person here was amazing. I learned something from everybody. I just want to say thank you to everybody.
Absolutely. Yeah, no, Matt, that was extremely well put. Do your homework. Where are they filed at? Are there entities in good standing? Do they have reviews? How long have they been around? Are they registered with the SEC? Have you looked at their Edgar filings, right? Talk to the owners. Homework's essential, right? You don't want to just jump into any investment by doing a quick Google search.
Definitely. I put something in the chat just now, guys. freedomin3.com. That's the event we're having next week. And on the second day, I spend the entire time going over, we have a due diligence checklist that we use. And so I'll spend some time, I give it to you guys, and I spend some time going through it so that you can just like real easy, like these are the questions I ask, these are the things I do, this is where I look in order to do due diligence before doing an investment. So that's what we do personally and at Sugo Capital. And then in addition, what we do, because I was even scammed by someone in PR, a PR company. I was like, I didn't expect that. And I thought I was so thorough. You know, I talked to their references. I found their clients on LinkedIn and I talked to them, great referrals, all this kind of stuff. And it's still, you know, they took the deposit and went away. And so now I hire a private investigator, and it might seem overkill, but I do. A private investigator who goes, if it's a company or an individual I'm going to hire, I'm going to work with, I'm going to partner with, I'm going to invest with, I have a private investigator. So they don't do like a 3 to 5 year background check. They do a 20-year like gut pull on the person, and I see everything. And then I can make a really thorough decision. And it might seem overkill to some people, but it's like $2,000 and I walk away from things, or I dive into something feeling really safe. So that's an option too.
And the one thing I would add, kind of since we started off on this question, this topic around like scams and like how can these things happen, especially now that we have more technology and more ways of getting scammed, if you will. I think one of the key things to remember is that when a scammer or a phisher is reaching out, they're trying to get you to go down a certain path and to take certain steps. And so the simplest thing you can do is to branch off out of that path, right? So for example, if I get an email, say from my bank that says, hey, you need to verify some transactions, I go to the app on my phone for that bank and I log in and I see if something's happening. And that way I can break that cycle and I can still verify, and it still might be, 100% legit. But if I click on a link that's in that email, I'm following the path of whoever sent me that email. And that is really kind of, every time you do that, you are kind of putting yourself more at risk. And anytime you have the opportunity to log into whatever service it is, like yourself from your browser, as opposed to, taking that link that was provided to you, whether it's via chat or via email, like that is a way that you can kind of break that path. And that really is an easy way to kind of make sure that you're doing things, in control versus following somebody else's path.
I think something I would say is that going back to stocks is almost follow like a Warren Buffett approach. Understand what you're doing. If you're investing in things you really have no understanding of, why would you want to do it anyway? So, diversification for diversification's sake is not a strategy. So, there's a bit of work you've got to do as well. Yes, in researching that. I love Sarah, I love your thing. If we should do that for before people get married or start dating someone. $2,000 is pretty cheap.
That's a different webinar, guy.
That's well, it's a parallel thing, but yeah. Anyway, but in terms of when I did my MBA, I got taken over I got ripped off in a private business, and I vowed then, this is way back in 1998. I vowed then I'm only going to do things I understand, unless it's like betting on a horse race or with a sum of money that is inconsequential and I'm going to have a bit of fun with. So, okay, we can all have a little bit of fun with a little bit of play money, and just make sure you put that in the bucket that is counted as play money. But anything that's potentially serious, I don't think there's any real way of getting around the fact you should do your homework and understand what you're investing in. Otherwise, it is a gamble at that point. You're trusting people, unless you really know they know what they're doing. You're trusting a process and thing that you probably wouldn't advise someone else to do yourself. So that's just my 2 cents worth.
I believe that a lot of investors today don't like to read or look into the companies. they're feeding off what the salespeople are presenting. If you do a little research and a little background, like Judd mentioned, SEC, go to the SEC.gov and do a name search. Go to the Department of Corporations, where the company is located, and see if there's any discrepancies. But the average investor out there, and we're talking about accredited, they don't like to read. And they don't like to do their homework. I believe people have gotten really, truly lazy in the last 15 years. And I'm sure Dana will agree to me. You know, he's an investigator or a witness or whatever. It's sad, though, because look at the facts. But Guy, you made a comment that look at all the new technologies that in the past 25 years that everyone in this panel could have gotten involved in, from cellular to wireless cable to Wi-Fi technology to paging companies, low-powered television, .nets and internets. A lot of money was made, but a lot of people didn't do their due diligence as well. So I'm saying we need to do a little bit more research on the company, and make an intelligent decision. That's all. Keep your mind open to new technology.
This thing with AI as well, going back to Matt, is that AI is going to further decrease people's appetite for reading and for just rolling up your sleeves and getting your hands dirty. So, you know, with what I did, I mean, I'm 53, so, you know, I was in an age before I predate the internet. My kids think I predate the dinosaurs. But the point is that, you know, we were used to actually having to read stuff. And, you know, when you were to create a program in those days, there wasn't generative programming in those days. You had to actually just wade with the data. That's how I created a lot of my stuff is physical, well, I say physical labor, but a physical labor at a computer screen. And so with AI, Matt, coming in so rapidly in every walk, so your support can be done by AI. You know, businesses can have whole departments, run or 80% run by AI. What's the future for future generations actually being able to read when reading to them is like that? Swipe, swipe, swipe. Even, you know, from every angle of life, whether it is dating again, where they need your private detective again, Sarah, but also from just anything, watching a video or reading an article in a newspaper, it's just a swipe. So that's going to hold some real challenges, I think, for future generations.
I'd like to speak on that, but Dana, you go first and then I'll jump in.
Well, you know, in my business, I've had to defend myself from so much fraud. I feel like a goalie in a hockey game with pucks coming at me all the time. I've seen everything. So this is no news to me. But what Theo said about going down a separate path and doing due diligence as well, I mean, that's just common sense. Just use your common sense and independently verify what you're being told. And I do think AI is going to enable higher degree of fraud to come at us. I mean, there's a recent phishing scam that's been going around the precious metals business where people are cloning Microsoft computer update. They're hacking into the computer. They're getting clients' banking information. They're telling the clients the bank's being their accounts in jeopardy from inside their own bank. Buy gold and then give us the gold and we'll hold it for you. And people have actually done it. There's an FBI warning on this. So you've really just got to be careful what you do. What Carlton said about, you know, not trusting anything you click on is, I think, paramount. So just use common sense. And Guy, you're right. I think we've got to teach people, our younger people, what they really need to know, because we're creating a society of people that are doing less work for themselves with everything we've given them through technology.
I certainly agree with all the commentary here on the concern regarding AI and the scammers, but I do have a slightly different perspective on it, a slightly different take on it. I'm not sure we're going to be able to fix the societal problem of knowledge in America. I'm not sure that's in our purview here. What I would say is,
What's the next summit?
if the American consumer wants to voluntarily reduce their knowledge, it's going to allow us a lesser competition for the rest of us. And I don't see that necessarily as a negative thing for the investor. It's a horrible thing for the consumer. And that's a completely different conversation. It's knowledge. And what I'll say on that is basically this, guys: in the land of the ignorant, knowledge is king.
There's a movie called, it was a very bad movie. It was very badly executed. There's a movie called Idiocracy. And the point of Idiocracy,
Great movie.
This was I think it was like 20 years ago even. It was a long time ago. But the theme of the story is that these two absolute idiots were frozen in time, and then they were unfrozen about, I don't know, 50 years later, and now they were the geniuses of that age. And if you think about it, like it's kind of a interesting proposition when you think that, you know, even with human evolution, I mean, the human race has been dragged along by relatively few people. If you think about it, there are a few great geniuses out there, but yeah, it's a, you know, I take your point, Matt, that yeah, it's great for the people who do immerse themselves in knowledge and do reading and all those kind of things. But if you think of the rump of people who won't do that, that doesn't bode well for an economy. It makes for a much more lopsided economy, and it will squeeze middle class and all these other things. So I think there's some definite issues coming forward just by sheer demographics. It's going to cause problems. It'll be interesting to see what happens as a result. Many more worker bees.
The good news is that the hundreds of people who are still on here are the ones who are learning, the ones who are gaining the knowledge. And so we're happy to have you join us, and we're happy to continue to speak with each and every one of you. So there are still a whole bunch of questions we didn't answer, but we're going to wrap, and I encourage you to reach out to each speaker. Again, tomorrow we'll send out the replay, and it will have links on how to get in contact with everyone, how to, you know, download the free gift that they have for you. And they all really would love to continue the conversation, to continue the knowledge journey with you. As you could see today, everyone is knowledge first. They love educating, teaching. So as you get on their email list, I'm sure you're going to continue to learn more and more. And speakers, I want to say thank you for spending almost your entire day with us today. It was really a treat to be on the stage with each of you. And I loved what I learned from each of you. And I look forward to next time.
Thank you, Sarah.
Thank you, Sarah.
Thank you all.
You're amazing.
Yep. All right. Bye, everyone.
Nice meeting everybody.
Bye, everybody.
Have a great
Take care.
one.
Thank you.
Bye-bye.